My biggest fear for this stock market is coming true. Everything is playing out exactly how it needs to be played out perfectly. It's unbelievable. It's brutal, man. I was getting tore up. I was like, oh my gosh, it was stocks falling 20, 30, 40% all over that market. And it was like quick. The moral of this story, ladies and gentlemen, is it is extremely possible we're going to have a 2018 play out. Before you ever put a dollar in a stock, you got to be thinking about all the things that could go wrong with this investment. If you're not running a bear case scenario, thinking about what could go wrong, all the things that could go wrong, you're playing this game wrong. You gotta understand there's a lot of opportunities to make money in the market, right? This is my new building giant. This is a new stock I've been buying that is going to be a giant position for me. So things move rapidly when it comes to tech stocks. You don't have all the time in the world. People don't see it yet. They will see it in 26, 27, 28, and that's why I need to build out this position rapidly. You got to be flipping my flapjacks. My biggest fear for this stock market is coming true. Everything is playing out exactly how it needs to be played out perfectly. It's unbelievable. And so I got to share at the top of this video what's going on here, what it means for where this market's headed from here, and all those sorts of things. So we'll talk about that at the beginning of this video. By the way, I appreciate everybody joining me here today. I hope you guys are having a tremendous day out there. S&P 500 had some big gainers today. I just want to touch on a couple of these stocks real quick and what's going on there. Adobe came out with earnings. We'll discuss quickly what they reported and kind of my feelings on this. I'll also share my bull case, base case, and bear case for Adobe stock in this video here today. Then I'm looking forward to reacting to this video, consumer prices in the economy, all those sorts of things. Look at this. They got Rick Santelli and Steve Leisman this close to each other. Like, I just want to watch this because I want to see if they get in a fight. Like, these two guys, like sometimes it could come across that they got bad blood for each other. So that's gonna be a fun one to watch. Lloyd Blankfein, I haven't seen him in a minute. He used to be the big dog at Goldman Sachs. He's talking about where he sees the market going, the economy, all those sorts of things. I'm looking really forward to hearing Lloyd Blankfein. Like, literally, he's probably, I would say, of people in the banking space, the financial space of the past 20 years, he's definitely top 5 of the most respected out there. One of the best CEOs for the big dogs in the financial space. I would put Jamie Dimon ahead of him, but he's certainly very important. So I'm looking forward to sharing my opinion and perspectives on this video. Okay, appreciate y'all for joining me. One thing only I need from you. If you haven't already done so, please hit the like button on this video. That's all I need for you to do. And for everybody that's already smashed that like button, I appreciate y'all. Y'all are my heroes. Additionally, if you want to be subscribed here to the channel, you can certainly subscribe. We are now over, how many subscribers? 108,000? Somewhere around there. Appreciate y'all for being here. Additionally, I got 2 free resources for you guys here today. One is if you're looking for my portfolio management checklist, that should be very helpful for you. I'll put that as a pinned comment down there. Can send that over via email, or if you want to text over, can do that. And then also my how much money you need to retire workshop. That's a really good workshop. I think a lot of you guys will enjoy it. It's a free resource. If you want access to that, can send that over. I'll put that as the second pinned comment down there. So, you might want to grab both the resources. They're free, okay? Alrighty, guys. So let's get rolling here. It's my biggest fear for this market, and it's all coming true. What's happening? Well, if you've been watching me religiously for this year at least, right? You don't have to be subscribers since 2016 like some of you guys are, 2017 or 2018, 2019. If you've been watching me this year, I've constantly brought things back to, man, this year is so similar to what year? 2018. Everything is playing out exactly how it should here. We're blowing through new all-time high after new all-time high. This is a year to date for the S&P 500 in the Qs. And why don't you have a little peek at this? It is exactly at all-time highs. Qs are now up about 14.5% for the year. S&P 500 up 12.2%. We're running right into rate cuts. But if you know my fear around the market, it's kind of been that essentially we would run right through rate cuts, and then very, very shortly after rate cuts, within probably a week or two of rate cuts, you could actually see the market actually go through a pretty significant kind of downtrend, right? Now, we saw in 2018 a lot of volatility in the market. And basically in 2018, early in the year, just like this year, we had a lot of early year volatility in the market. A lot of early year, February, kind of all the way through April, right? Which is exactly what we had this year. Now, in 2018, it wasn't as rough as it was this year. This year was way more dramatic as far as volatility in the market falling, right? With the whole tariff drama and all that, right? Liberation Day, as they called it. Now, the fascinating thing is here, with this potential fall that we could have this fall, and once again, this isn't guaranteed, but everything's playing out exactly how it should play out here, which is creepy. And I'm looking and I'm like, everybody's expecting a massive downfall in the fall time like we had in 2018. If we were to have that, actually, no one's really even talking about 2018 for the most part. But, if they are, I think a lot of people would expect a big downturn. It's possible we could get an inverse 2018, where essentially the most dramatic downfall's already happened. And yes, we do get the market to fall in the fall time, but it's not a dramatic downward move. It's not like, off a cliff like it was in 2018. Like I remind you guys, we were deep into December. I think it was just as of December 21st, 2018, from what I remember. We were on pace for the worst December since the Great Depression for the stock market. It was brutal, man. I was getting tore up. I was like, oh my gosh, it was stocks falling 20, 30, 40% all over that market. And it was like quick. And if you weren't in the financial markets, you're like, what even happened? Like, it wasn't like the economy crashed. It wasn't like anything crazy happened. At that time, there was worries about the Fed, being kind of stuck in their ways, not lowering enough, and they did start to lower in 2019. There was also worries about a little bit about the state of the economy, but that was like more of a minor worry. There was also worries about tariffs, which is something we certainly have going on, right? And do understand the Supreme Court's going to decide in likely the fall time what is going to happen with tariffs. Are those extreme levels of Trump tariffs going to be blocked or not? So the moral of this story is here, folks. The moral of this story, ladies and gentlemen, is it is extremely possible we're going to have a 2018 play out. But like I said, it's possible it could be an inverse where it's a down cycle where maybe the S&P 500 goes down 8 to 12%, but not more than that. And it doesn't do like a 20% drop like it did in 2018 or like it did earlier this year. It's very possible that could be what plays out. So what I'm going to likely end up doing is if I'm going to put any hedges on, I'm going to get them on probably the last 2 weeks of September. A lot of times I'll wait till, later in the fall time to do my hedges, right? Maybe even wait till December. I think this year, especially if this market just drifts higher over this next 3 weeks, I think I'm going to put on my hedges early. Get them in there and we'll see what happens. It might be fireworks. We'll see, okay? So, yeah, interesting times, right? And other than that, obviously, I do my weekly buys. I'll be doing my weekly buys tomorrow in the public account, my Patreon portfolio, and my private portfolios. You know what I'm going to do next Friday? Buy in my Patreon portfolio, the public account, and in my private portfolios. I do that every single Friday, okay? Now, I want to talk about a few stocks quickly here that were some huge moves today. Warner Brothers and Paramount made a massive move. One was up 29%, the other was up 15%. So they're supposed to be combining together here. It has Larry Ellison supposed to supposedly be involved with this, who has basically an unlimited bankroll. So there was actually worries around Netflix today that they could form like a serious competitive threat to Netflix. If Larry Ellison's back in it, it's just, an unfair advantage. So we'll see. We'll see what happens with all that. But that's what was kind of going on there, right? Synopsys, that was a huge move, but that was down massively yesterday, so it was just a big bounce back. Micron caught my eye. That one was up 7.4% here today. And the reason being, I don't know how many of you guys follow Micron, ticker symbol MU, but this is a company that's just in the perfect spot. And the reason being is their memory is needed in a massive way. And with how complicated these chips and how the need for memory is very bullish for Micron for the next few years. Now, when this chip cycle slows down in a major way and comes to a grinding halt, maybe in 2-3 years from now, it's not going to be good for Micron stock price. But for right now, it is a party. It's a party. And the party's going to likely keep going on for at least, I would say, 6 to 18 months here in regards to MU, right? Now, by the way, Micron's not a company I really like for the long term because they kind of go through, it's a cyclical company. Like 1 minute they're able to get unbelievable pricing for their memory. The next minute it's like, they're having trouble making profits. Like it's so up and down with them. But basically Citi upgraded them, and they said Citi said they expect much stronger expected guidance on data center demand. We expect the company to report inline results and guide well above consensus, driven by higher DRAM and NAND sales and pricing. We believe the continued memory upturn is being driven by limited production and better than expected demand, particularly in the data center market, 55% of Micron's revenue there. Okay. They believe DRAM upturn is intact, and our checks indicate demand for the AI sector increases sharply. And the bottom line is, like, Micron's just in the perfect place. And, you know, I have a friend that's a big shareholder at Micron. And you know what I told him in regards to Micron stock? I told him this like probably a month ago or a few months ago. I said, if there's ever a time for Micron to go 200 plus, it's in this next 6 to 12 months. Like, this is the time to make it happen. Like, Micron stock always trades at like dirt cheap valuations, but if there's ever a time this baby goes 200, it needs to be in this next 6 to 12 months, because this is just everything you could possibly imagine is going perfect for them. NVIDIA's revenues are still blowing up. AMD is about to accelerate growth in a massive way, right? We know all the companies like the Broadcom's revenues are skyrocketing and are expected to continue to. So it's just the perfect storm for Micron. And so the numbers Micron's going to post over this next 1 or 2 years, it's going to be pretty shocking. Their net income, their revenue growth is going to be outstanding. But once again, keep in mind, Micron stock will peak way before the cycle peaks, because people will already be pricing in the downside. It's part of the cycle, which is never fun, because basically Micron gets squeezed in regards to pricing. It's brutal. Okay. So Adobe, they came out with their earnings just about less than an hour ago. Earnings per share $5.31 versus $5.18, so nice beat there. Revenue $5.99 billion versus $5.91 billion, slight beat there. You know, Adobe is not a company that you would ever expect to just like crush it. Like, oh my gosh, can you believe how much they beat by? They're kind of more of a Microsoft type company, where like Microsoft, you're like, yeah, they beat earnings, but it's not like an NVIDIA or a chip company or something like you just never saw coming, because their revenues are very steady. They have a lot of monthly and annual recurring revenue. So it's just a much more predictable business model, but there's not like that excitement of like, oh my gosh, Adobe reported $7 of EPS when $5.91 was expected, right? Meta is a company that can just blow your socks off. Shopify is a company, even to a certain extent, that could knock your socks off. Revenue increased 11%. It's a nice increase year over year, from $5.41 billion a year earlier, Adobe said in a statement. Net income rose to $1.77 billion, or $4.18 a share, from $1.68 billion and $3.76 a share. For the fourth quarter, the company says earnings per share will be $5.35 to $5.40, so we can call it about $5.37 midpoint there, $5.38 midpoint. Top and analyst estimates of $5.31. Nice. Adobe's guidance for revenue came at $6.08 billion to $6.13 billion, so we can call it like $6.1 billion basically. Analysts were at $6.08 billion, so slight beat there. That's just a game of Wall Street, right? Perfect. I mean, you know, I don't know what else to say. I graded the income statement. It was an A- income statement. I graded it. I put it in the private stock group. Like, it's good. It's really good. You know, like, all Adobe has to keep doing here is just come through with numbers. Like, they're coming through. Just come in, beat your numbers. At the end of the day, this notion of like Adobe is going to be, irrelevant. They're going to make it irrelevant. Like, it's, AI is taking over. Like, no one's going to have Adobe anymore. Adobe products. It's just ridiculous. It's just ridiculous. And Adobe hasn't even really begun to see the positive effects of AI yet. I think that's really a story that will play out 26, 27, 28, and 2030s. So right now, this is really just their core business, increasing revenue 11% year over year. Like, that's great. Just keep executing, man. Cheap stock. It's going to be a Google type situation where, stock will get moving, and then next thing you know, it'll be up 50% quick, and I'll be like, whoa, how did Adobe just move 50%? Like, oh my gosh. Here's my bull case, base case, and bear case for Adobe stock. So what do you notice when you see my bull case? Something should stick out at you. It should be that revenue growth. Under my bull case assumption, I have revenue only going up 10% a year. Why does that matter? Because they just grew revenue 11%. So I have my bull case being less than what they just grew revenue. And remember, they haven't even really seen any positive effects of AI yet from the revenue standpoint, right? I have net income increasing 12% per year on average. A 25 to 30p is pretty fair for a company growing, very low double digits revenue and net income. And for a company that has recurring revenue, like obviously Adobe does. And that gives me a basically compounded annual growth rate of 21% on the low end, 26% on the high end. I'm taking that. My base case is so conservative. Look at this. I have their revenue only going up 8% per year the next 4 years. It's nothing. 10% net income's up, 37% net income margins, right? So a little increase versus where they're at right now. 23 to 28p ratio is extremely fair for a recurring revenue business model growing 8% top line, 10% bottom line. That puts the stock somewhere between $633 and $771 come 2029. Gives me a compounding annual growth rate somewhere between 16 and 22%. We can call it, 19% midpoint. Beautiful. Like, how? Free money. Do you like free money or not? Adobe's just like, free money, here you go. All right. In my bear case, I haven't only grown revenue 2%, like they got disrupted or something, right? And then I basically make no money in the stock. So the moral of the story is here, Adobe is a buy. Alrighty, let's react to Rick Santelli and Steve Leisman and see if they get in a fight.
Or Steve?
Up 0.4% versus an estimate of 0.3%. Real earnings minus 0.1%. Obviously, the inflation number's taking that off. Let's see what we got here. Year over year, headline 2.9%, right in line. Ex-food and energy 3.1%, right in line. No adjustment to the prior number. But the one thing is the headline, the core at 0.3 is exactly in line with estimates. Let's see what else we have here. Unadjusted. That's all I have right now, Joe. How's food was up 0.5%, so some pressure there. Food 0.4%. Owner's equivalent 0.4. A little bit of pressure right there. I don't have the actual table yet, but I'll get that in a second. Taking a look, see if the bond market is reacting at all. That's what Rick would be telling us, but he's going to be here in a second. I still have the 2-year at 351. Rick, do you remember where it was going in? I can't remember. 10-year at 4.01. So that's actually down a bit on this number. Yeah, pretty big decline. I think market's seeing essentially, Joe, this inflation numbers in line with expectations. Okay. The key here, and I'll dig into the numbers, I expect to find tariff inflation in there. The key all along, the main risk to all of this was it going to spread to other things? That does not appear to be the case. That was the risk that held the Fed back. We can argue, did it make sense for the Fed to guard against that kind of risk?
Is this a big moment, Rick? Is
263,000? Is that what I'm seeing on initial jobless claims?
I didn't see that, Rick.
Yeah, 263,000. That is the news of the morning. We haven't been above 250,000 since October of 24. So 260,000, where's that going to comp to? It equals where we were in June of 23. To find a higher number, you're back to October of 21. To me, that's the biggie. We're talking about, is the Fed fund futures market going to potentially price in 50? That is your catalyst to actually get there.
To price in 50. Where's the 10-year, Steve? I was thinking we might get a 3 handle.
10-year coming up. 4. That's what the market's reacting to.
Exactly 4.
Not the inflation number.
Exactly 4.
We're waiting for that under 4 number. Your buddies in Chicago who have the calls on that part, right?
On the 4th of, April, when we had our 3.99 yield close, low close for the year for 10s. In Chicago, everybody was betting that we were going to spend a lot more time under 4%. I took the other side of that. I think debt and deficits matter. I think the yield curves matters. So I still say, even if we close, and it's based on a close, and a weekly close is your highest priority from a technical perspective. And once we get that, I think if I was a trader, I'd probably still end up fading it. I think if the Fed cuts 50, the yield curve steepens 25. I still think 10s are going to be there, and they're going to be stubborn. It makes me upset when I see everybody talking about 30-year bonds. 30-year bonds haven't been the biggie in over 20 years. And just because the UK and the Japanese, they trade those things by appointment, it gets distorted. Arbitrage keeps it in line. But you want to watch the 30s versus 10s spread, 5s versus 10s, the fight, the knob, because the steeper these get historically, the more that tells me that the premium in between these maturities is going to keep getting wider and wider.
Rick, I want to just cut you off for a second because I want everybody to take a bit of a chill pill here on this jobless claims number. I'm trying to run it down. There was a spike of 15,000 in Texas, and I don't know why that is. It could have been some kind of special sort of thing it could have been in local education or something like that. But if you back that out, it looks a little less drastic.
Traders don't like backing anything out of the garage. They look at everything in there, whether you have jalopies or limousines. It is what it is. These numbers have never been accurate, and I think that they're going to pay a lot more attention.
That's what I was going to ask. These numbers, the revisions that we've seen, how much attention do you pay to this the first go-around?
Exactly. Like, in all seriousness, how much can you even trust these numbers? Like, maybe they're a little better than this. Maybe they're way worse than this. Like, it's sad, but there's such a distrust in any of these numbers. The thing you got to understand, this distrust around these government numbers is not new. I remember just getting in the financial markets, and that was back in like 08, 09. And I remember my dad, even back then, he said, "Oh, you can't believe any of that government data they feed you." Like, that was him, what was that, 17 years ago, 16 years ago or whatever, right? And he wasn't even the person that was like into the market, and he already had that view. So just understand there's been a distrust around government numbers and data for a long time, way before 2025, okay, for my youngins out there.
Treasury Secretary really kind of nailed it, and it made me a little nervous because basically he said it's not about maybe tweaking how we do the numbers. It's now becoming a case for how do we need to reform the Fed, and his logic is almost very hard to refute. If they're data dependent and the data is horrible, then maybe we do owe the markets more of a cut. I'm still an inflation hawk, but to see these numbers, especially on the producer side with no pass-through, I think a 50 is almost called for. And believe me, I'm not in the camp. Listen, I'm not going.
Rick Santelli saying a 50's called for? Whoa. I was not expecting that big of a statement. I understand probably a lot of people watching this video right now is like, what's the big deal about this? This is a big deal. Rick Santelli calling for a 50? Saying that's warranted? Rick Santelli?
These numbers, especially on the producer side with no pass-through, I think a 50 is almost called for. And believe me, I'm not in the camp. Listen, I'm not going to be auditioning to be Fed chief, okay? So I'm not going to tell people, if the Fed needs to cut. I think with record prices and equities, I agreed with most of Jay Powell's logic, but I think things have changed dramatically. And that 911,000 revision, more than half of those jobs taken away, that really does change.
Did last month, was it CPI first, then PPI? This month, was it PPI, then CPI? So it was like that.
Yes.
So last month, PPI was great. CPI scared the hell out of everyone. This month, PPI was great,
good.
And CPI was in line.
CPI is okay, yeah.
I want to know what Lloyd Blank
I just want to take the other side of Rick's trade here real quickly, which is...
You're sitting next to each other. Do not get into one of those. Actually, maybe I'd be good.
Hey, what did I say earlier?
Why not?
Whatever's best for ratings.
Well, I just don't want any fisticuffs. Okay, I do want
ratings.
You're right. Okay, go.
Very quickly before Lloyd, you have a GDP running at a tracking forecast of north of 3%. You have the stock market near all-time highs.
At all-time highs.
Or at all-time highs, at or near. I get that the Fed can come down because it's restrictive, and there is not necessarily a reason to remain restrictive. There we go, a big bump, by the way, in the probability of the second cut, more confidence in the third cut this year.
Wow.
And I'm good with that. The question becomes, how far down should it go? How far from neutral is the Fed? It's Because there's a huge
Who
debate.
the heck knows what neutral
Let me
is?
finish, Rick. There's a huge debate about what the right break-even rate is for this job market, given what's happened to immigration. We may be very close to that number.
If they let those guys go long enough, they'll get in a fight eventually. It's just due to happen. You just know it's due to happen. The moral of the story is, in all seriousness, in regards to what this means for the market, is market's going to be more excited than ever about a lot of rate cuts coming. That just is what it is. Now, the problem I think we're getting into here is, if you're cutting rates, if you're starting to say, okay, we got a lot of rate cuts coming, it's kind of scary in a way, because that could mean you're really, really, really actually legitimately fearful about the state of the economy and where this economy is headed. So that's something you got to factor in. People assume like, oh, rate cuts mean great things. Not always. I mean, heck, they cut rates like crazy in 08, 09. I think they started the rate cuts in 07, I want to say. But they were cutting like insane in 08 and into the beginning of 09, right? All the way down to zero. Did that mean good things for the stock market? No, the stock market still went down 50% from peak to trough. Did that mean good things for the economy? No, the economy was in shambles. We had like a 10% unemployment rate. It was ugly out there. I was so thankful to just be able to get a job at Einstein Bagels making $7.50 an hour, and then be able to upgrade my job to $8.25 working at Walgreens at 18, 19 years old. Like, I was thankful. Like, oh my gosh, it's hard to get a job out there right now, right? So yeah, when people start being thankful for a job at Domino's, you'll know you're in a bad economy, essentially, okay? Next one up here, former Goldman Sachs CEO Lloyd Blankfein. I'm looking so forward to watching this one.
This is quite a morning, because there's a lot of things that we've been talking about. Charlie Kirk, 9/11.
No, it's kind of, I don't want the whole conversation to be so sober, but it's a sober moment to reflect on. And of course, I was downtown all day, worked downtown, and every night on TV, these lawyers run these ads for people who got diseases from breathing in that stuff. Of course, I had lymphoma, so I always get reminded when I watch late night TV of the consequences of working alongside the World Trade Center that day and for months afterwards.
I didn't connect those two, but yes, you did. And
yeah.
You're better than ever, but I remember, and you can't say for sure, but why wouldn't you at least think there's some linkage there?
Well, people who weren't downtown get it, and people who were downtown don't get it, so you never know, but it's an environmental thing. And so every time I see one of those ads for people to join some class action or something, I don't do it, but I think about the consequences of that day.
What do you think about it on a
Yeah, I don't think Lloyd Blankfein needs to get in a class action. I mean, that man's got a few dollars to his name. I think he's doing all right.
This, meaning we're 24 years later. And to the extent that there's generations of people who may not even understand it or know it, what took place that day?
I think of circle of life, Simba. Life goes on, and people were too young to remember it. And I was born. After World. People in World War II. Did I live through World War II? The other day I was talking to somebody, and they were reflecting, and they said that their nephew didn't know enough about Vietnam. And I said, well, he was born further from Vietnam than you were from World War I. And so it's just the nature of things. And, it's good. It's part of the charm of life. You don't get too overly saddled with the consequence, with things that just came from the past, and we can look forward as we're going to do this morning.
Okay, so let's do that right now,
Yes.
Which is, I always think of you as someone who thinks about risk, as a risk manager. So where are we today in America in terms of our economy, in terms of all of the different cross currents? We got tariffs, we've got issues about the Federal Reserve and what they're going to do or not do. We've got questions about the independence.
Yes, well,
politics.
We certainly have a wall.
What does the risk manager that is Lloyd Blankfein say about all this?
We have a wall of worry, and look, we're about to lower interest rates into a bull market. So I would say the setup for the markets is pretty benign, and we can go over a lot of details, but everybody else, talks about that. And then you have to worry about a lot of things that could go wrong, which, I always lived life, spent 99% in the 1% of the things that could go wrong. So it explains a lot of my unhappiness all the time. But the way but people are hard pressed to come up with it. People don't see a lot of leverage, and they don't see this and they don't see that. The way I used to try to draw people out is I never used to say what could go wrong. I'd say, you just, you were swimming in the Arctic, you got frozen in an ice floe, you melted down, and a year later, I'm telling you the market crashed. Tell me what happened. And then people could come out and say the likeliest things that probably could have happened. And it usually involves around leverage in this time now, probably credit, leverage in places that you don't see it. And, there's certain environmental hazards that are here. And then I used to think to myself, if I could think of it, that's probably the last thing that would happen. But I look at credit spreads being so narrow, so much money going to private credit, people trying to, goose their returns a little bit by leveraging up in kind of odd ways, at the portfolio level or other levels.
Right.
And so, leverage starts to think in. I think of the places where this is being done. A lot of these assets are being put into insurance companies where people are feel kind of assured because the long term, they're investing premia for longer term liabilities. But if I were an insurance regulator at some point, I might say, are those assets really worth what you say they're worth? And are they going to come? Is it going to come to pass that you'll have the money to pay your liabilities? And let's look at that and let's mark them and let's take. There are a lot of things like that I would be going out and we'd going around the table and then somebody would say, well, I don't think this or that, and I'd say, well, I don't care what you think. Just tell me what might happen.
But do you say to yourself, though, these are sort of 1% risks, and otherwise, as you said, we're in this benign environment?
So what he just said there is really important, not for actually what he's talking about, thinking about the market, because, market crashes, corrections, blah, 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 it's going to happen, and a lot of times you won't see it coming, and that's fine. But the way what he just took you through is extremely important for every single person watching this video right now. For what? For stock picking. That's how you need to be. Before you ever put $1 in a stock, you got to be thinking about all the things that could go wrong with this investment. And that's such an important point. And I even actually made this point to my prep stock group members recently. I said, hey, I see a lot of you guys run bull cases on stocks. And some of you guys run bull and base, but I'm not seeing enough bear cases. You got to run your bear cases for your stocks too. When I do my Adobe numbers and every other stock I run numbers on, right? I run my bull case, I run my base case, and I run my bear case. And I run them all a little more conservative too, which is also very important to do. You don't want to be, too aggressive with your numbers. But if you're not running a bear case scenario, thinking about what could go wrong, all the things that could go wrong, you're playing this game wrong.
I think you're saying is a bullish environment and continues apace? Or do you say
there's a lot of 1% risk, but it's not a 1% risk that something bad will happen. It always, look, we had, roughly the crisis of the century, roughly every 4 or 5 years. Debt crisis, emerging debt crisis in 1994, big crisis 1998, long-term capital and the Russia debt default, dot-com bubble, 2000, 2001, 2007.
We're quick learners?
We're kind of,
Or are you saying we're due?
I'm saying we're due. And it doesn't matter that you can't see from where it's coming from. Now, having said that, the other thing I used to ask people all the time is, it's so, you sound so much smarter when you're bearish. Then I used to say, what do you think? And then I said, what are you? How are you positioned? And,
right.
I have all these bearish thoughts, but I'm 100% in equities.
Personally, right now,
because because we're about to lower interest rates into a bull market. Anything having to do, there's anything having, people who can't spell AI, but will buy anything that's associated with it. People think it's it's an epic moment.
And do you think it's an epic moment? Is the trader that is Lloyd Blankfein buying all of the mag set? Like, when you say you're 100% in equities, what does the portfolio look like?
I think it's a phenomenal moment. It might be. I'm not a great technologist, and I've lived through waves of technology, and I experienced things that changed the world, and I experienced things that changed our fortunes because we overinvested in stuff.
Lloyd, have you ever not been 100% in equities? Was there ever a time where you thought, okay, this is getting scary, I'm going to take some money?
And let me ask the corollary to that, because we go back a ways and we've been in different forums. We've listened to you and off the record things in foreign countries, that have a lot of skiers and stuff that we cannot talk about. But we've talked. You have always had a lot of things that concerned you, and you say it's 1%, and you're a risk guy. I just want to know, and answer Becky's question too. On a scale 1 to 10, you're always worried about all these things. Is it more or less right now than normal? Because that's the only way as a risk guy. And you've always been able to stay 100% invested, even though you're always.
Well, listen, we had, you divide the world into, your outlook in two parts. What do you think is going to happen? What do you bet on? How do you position yourself? And then you get into risk management mode, where I don't care what anybody thinks.
You gotta love Becky, right? Becky just gets in there and asks a question. You're like, have you ever been not 100% in equities, right? Then Joe comes in, like, distracts him and goes on like a 2-minute rant on blah, 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 blah.
And then you get into risk management mode, where I don't care what anybody thinks. Just what could possibly go wrong? Let's look around the corners.
That's when you're managing for a firm.
Right. Well, I think about that.
Versus what you're doing.
So the answer is, I think the investing market is all tailwind.
Yeah.
Except it can't possibly be. So I have to work. I have to work to find. I work to find things. But that's the nature of my. That's the nature of my life.
I think when you were managing other people's money, you were probably more cautious with it than potentially your own. I mean, I'm just guessing. Or is there a time where you were ever not 100% involved in equities?
Oh, sure.
Yeah. There was a time when you took
yes,
the table.
But I don't know. I don't know if it correlated with what the reality. I used to. I'd say to people, if people looked, very happy and the world was benign, I'd say to people, I haven't felt this good since 2007, or I haven't felt this good since early 1994. I thought the birds were chirping and the sun was shining in those periods of time, and who knew?
But I guess that's what I would ask. Is there a time that you've ever taken money off?
She's going in for a three piece. She's going in. She's not letting this go. Good for her. I wish Becky would have just done this whole 9-minute conversation. It would have been more insightful.
Well,
yes. I feel
what caused you
to answer your question in the risk-taking side of things. I feel very, very good about things, and in fact, but kind of informs my sense of foreboding. Yeah. That I haven't felt this good since 2007,
right?
Or 1994.
But you don't know when it's going to come, so there's not a whole lot you can do about it.
Well, I think you have to protect the tail risks. I wanted to own lottery tickets, not write them.
Right.
And you start to look at, in times like this, I want to go around and I want to see, what's really susceptible. What could go, if something went wrong, what would the impact? And so you can move up the credit curve and you can move up the higher value curve. And I think that's not a bad thing to do now. And it happens to conform to my view of the market, because I think the most exciting companies, the fastest growth, usually size is the enemy of growth.
Right.
But here you have the biggest companies who are positioned to take advantage of the new technologies because they can afford to, have been the best ones to go in. But then you go and other people are coming to the market today with companies that are the next level down, the next level down, next level down, and those are riskier.
Dang. He never answered the question properly like Becky was asking. Oh, well. 3 stocks I bought here today, and we'll discuss that in this video. But this afternoon definitely screwed up my schedule. This video would have been out many, many hours ago. Obviously, I heard about the big news here today. Charlie Kirk was shot and did pass away. Now, as you guys know, I'm not very into politics, but I'd seen several of his clips over time, right? And when I heard this news, it was very, very troubling. And the reason, there's a multitude of reasons why this was troubling. It shows another day of gun violence in the United States of America, right? But another big factor is there's been a string over the past 5 years of violent attempted actions or actual violent acts, basically against politicians or people that are in the political realm. And there's a long list of them over this past 5 years. And I think we're just going through arguably the most divided time in the United States of America. And it's just brutal. It's just brutally sad, that something like this happens, right? I put this in my private stock group today. I said, I feel so sad for his little girls. I believe he has 2 little girls who will now grow up with no father. Rest in peace to him. All Americans' freedom of speech got shot today. Let that sentence stick with you. All Americans' freedom of speech. Whether you loved that guy or you hated that guy or you were indifferent, whenever somebody like that that has a point of view, and he shares his point of view, when he gets taken out like that, everybody's freedom of speech gets shot in a situation like that. And I think that's something everybody's got to, come to grips with, right? And, additionally, I believe somebody corrected me and they said, oh, he actually has one boy, one girl. So I thought he had two girls. And then I was on X, looking around, and, I was even for a few hours there, and I was sharing stuff with people. I'm like, can you believe what this person said? And how could they have this take? And how could this person be this? And I was taking screenshots and sharing it around. And I just realized, I posted this on X. I said, I'm so done with X today. I said, F this. So many people being so radical. Some justify the shoot, and some saying the entire Democratic Party needs to be eliminated. It's just ridiculous, man. And situations like this really bring out the worst in people in regards to, a lot of commentary. It's just ugly, man. It's ugly. And so, and I think things like with how radical some people are on social media, I think that leads to some of this stuff that we end up actually seeing in the real world. And it's so sad, man. Such a sad situation. So rest in peace to Charlie Kirk. And let's hope, this is an end to this sort of violence against, either politicians or people in the political realm, because it's, just ridiculous. As far as the stock market went here today, there was big news around Oracle. That was the shining star of the stock market. It was up nearly 36% here today. Larry Ellison's net worth grew a little under $100 billion in one day. Larry Ellison's net worth was up $94.5 billion. Unbelievable number there, right? Oracle now is the 11th biggest market cap weighting as far as the S&P 500 goes. So a very important position now, the S&P 500, 1.58% of the weighting of the S&P 500. Now it looks like it's not that meaningful when you look at stocks like Nvidia at a 7% plus weighting, or Microsoft at a 6% plus weighting, but believe me, that's really a large number there. So very, very meaningful. In today's video, I will share what I wanted to share with you guys many, many hours ago, but it took a while to get here, but I'm here. I'm going to share with you one stock I sold here today and why I did it, went ahead and did it, essentially. I also going to share with you 3 stocks I bought here today and why I went ahead and bought those, okay? And let me say, I never take for granted all you guys that are subscribed to the channel, all you guys that hit the like button on the videos. I appreciate each and every one of you for always being here, and I hope you guys appreciate me, sharing stuff like this with you guys. I always get, a lot of comments from people like, you're a great positive part of my day, things like that. And I thought, on a day like today that is, really somber, obviously, hopefully I can bring at least a little bit of positivity into people's lives today. So I appreciate y'all for joining me. Additionally, I'm gonna give you guys 2 free resources here today that hopefully can help you out. I'm gonna give you my free stock picking checklist. If you guys would like access to that, I'll put that as the first pinned comment down there today, my portfolio management checklist. And then additionally, if you want access to a free workshop I have, I'll put that as a second pinned comment down there. This is how much money you need to retire. So hope you guys enjoy that, okay? Alrighty guys, let's get into this video here today. So major development happened that made me consider potentially selling this position, okay? And here's what happened, and then we'll get into why I sold the position. So basically, and this news has come out very recently, as in the past few days, the Supreme Court's going to agree to hear Trump tariff case this fall. Now, basically, there's a possibility that the Trump tariffs and all the huge Trump tariff rates that have been, levied, the 50%, 75%, 100%, like the huge numbers you've heard, there's a potential that could be actually illegal. And maybe Trump doesn't have the, we can call it, I guess, jurisdiction to, I don't know if that might be the right term or not, but he basically doesn't have what he thinks he has in terms of power to do something like that, right? So the Supreme Court's actually going to look over this and likely make a judgment this fall at some point in time. Now, this is very meaningful for this one particular stock I just bought here recently. And the reason being is when it comes to appliances, basically in the new Trump tariffs, 50% tariff was supposed to be on steel and aluminum content in these different appliances, okay? Now, there's a company named Whirlpool that approximately 96%, according to the company, approximately 96% of the steel used in their U.S. products is sourced from the United States. Now, for these other companies, a lot of companies as Whirlpool has to compete with, right? They're able to source their steel from outside the United States and offer products at extremely competitive pricing, and even can import those products or export those products to the United States of America, right? Where somebody like Whirlpool has, I believe it's 8 factories inside the United States of America. And so sometimes many of these companies, these other appliance companies, whether it could be LG or Samsung or some of these different competitors that Whirlpool has to deal with, they're able to essentially make their washers, dryers, refrigerators, blah, 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 at potentially cheaper prices in Whirlpool. Then they're able to sell them at cheaper prices in Whirlpool, and that makes it a very tough market for Whirlpool to compete in, right? Now, if you know me, you know I just bought Whirlpool stock very recently, September 2nd, right? Now, I was already up 3.4% on this particular position, and I said, let me go ahead and sell Whirlpool today. So if you remember my thesis in regards to why I was buying Whirlpool stock, it was really 2 parts behind this. One was a housing turnaround 2026 and after, which I do believe is going to happen. I do believe there's going to be a housing turnaround in 2026 and after in the United States of America in regards to people like actually moving. Like the numbers have been awful in regards to people moving for the last several years. And then the other part was this tariff situation. Now, one of my big theses is in serious question. Like, we'll see what the Supreme Court rules here, but I think there's a pretty decent probability the Supreme Court could actually overrule Trump's crazy, the big, huge tariff numbers. And so if that's an overruled situation, it's not ideal for Whirlpool, because then it just goes back to the old situation where, these other companies can potentially dump appliances in the United States or get steel and aluminum and other things from outside the United States. And so I said, you know what, I got to go ahead and cash this stock. And so I went ahead and sold the position. I had literally just started on September 2nd because one of my theses is like potentially gone. And I'm like, okay, I can get out with a 3.4% profit in a matter of a little over a week. I think I'm going to take that. Now, the thing you got to understand about Whirlpool is this company, right? It's not in a great position at all. It's in a very bad position. Like Whirlpool's financials are a dumpster fire. So it really needs both of these things to really turn this show around. It needs those tariffs plus a housing turnaround over the next several years. If you can get both of them, then we could talk about a complete turnaround. But look at the company's revenues. This is where we're at on a trailing 12-month basis. It's not good. It's not good. And so my thought was 2026 and after, the revenues start to trend back up again. Business gets in a stronger spot, right? I don't know if that happens. If especially with the whole tariff situation. So the company's been in an ugly housing bust for, quite some time. And in regards to the housing bust, like when I talk about housing bust, some people are like, wait, aren't prices like near all-time highs or close to all-time highs? Sure. But we have a massive housing bust that's happened over the last 3 years in the United States of America. Existing home sales are busted. Like literally, the only people that have been moving from 2023 through this year, 2025, are people that have to move. Like they really got to move. They're moving states. Like they're like, I got to move. Okay. Other than that, like it seems like literally no one is voluntarily moving in 2023 through 2025, right? Even myself, like I'll move next year, but 2023 to 2025 now. Nope, not moving, right? Now, there's 2 parts on why no one's moving in the United States of America. The one is mortgage rates. Mortgage rates are insanely high based upon what everybody got used to. There was over a decade straight, 2010 through 2022, everybody got used to 3 and 4% mortgages. I mean, some even got it 2.8% mortgages and something like that. But the moral of the story is everybody got addicted to 3 to 4% mortgages, and everybody got used to that. Well, 2023 through 2025, you know what the mortgage rates have been? They've been in the 6s or 7s. Now, when you go from 3 to 4 to 6s and 7s, and everybody was used to 3s and 4s, all of a sudden that's ridiculous. Like people can't even consider that. Even if people are in a good enough financial position, a lot of people are like, dude, I'm not signing my name on a 7% mortgage when my current house has a 3% mortgage. No, thank you. And so that's a huge deal we have, right? Part 2 of this whole story is in regards to pricing. Pricing's gone insane. Like we all know that, right? This is the pricing in my city, Las Vegas. I mean, yeah, it's pretty self-explanatory on where home prices have gone over the last decade. Up and to the right in a massive way. I mean, if this is a stock, it would have been a great stock to buy, right? We would have made a lot of money on it. So for those reasons, Whirlpool, it's just kind of a really tough situation. Now, here's what I'm going to do with Whirlpool moving forward. I'm going to keep an eye on it still. I'm going to have it on my watch list. I'm going to see what the Supreme Court decision is. That's going to matter meaningfully. But like I said, there's a decent probability those Trump tariffs are overruled. So if that happens, it's once again, it's not an ideal situation for Whirlpool. But I could jump back in Whirlpool at some point in time. It's just kind of a wait and see situation. Obviously the 3 stocks I bought today that we're about to get into, I think those are incredible opportunities. And you gotta understand there's a lot of opportunities to make money in the market, right? Maybe Whirlpool is not the one, or maybe it is the one. But regardless, I think other stocks are going to make me a lot of money. So even if Whirlpool does well, which I hope it does, I hope all stocks do well. Even if Whirlpool does well, and let's say not in it, like I'll be like, hey, I still made a bunch of money on these other stocks. So that's just something to keep in mind there. Okay. So we covered why I sold Whirlpool. Now let's get into 3 stocks I bought and why. Okay. Number 1 of these 3 stocks I bought here today and why is CRM, Salesforce. This is my new building giant. This is a new stock I've been buying that is going to be a giant position for me over time. I bought another 40 shares here today in the public account at $244.99 for this one. Okay. As far as my current position, it's up to around a $34,000 position, up to 140 shares. I made 2 buys so far. The first one was on September 4th, bought 100 shares, and then today I bought 40 shares. Okay. So obviously there's like no meaningful move in the stock so far. I just started buying the position. I need to build this stock out as quickly as I possibly can. I need to get this stock fully built before we get to Q2 2026. Now, some of you might look at that and you're like, that seems like a long time. It's not a long time. I got to build this rapidly, really, really quickly here. Okay. When you've been in the market 17 years, time moves faster, I guess you can say. It's kind of like when you're a kid. When you're a kid, it's like life moves so slow. It does it not? Like a new year is like such a long time to you. When you're like 50 years old, it's like, oh my gosh, like the years just fly by. It's like we're binge watching this thing, right? So with CRM here, I got to build this position out rapidly, in my opinion. And the reason being, when it comes to tech stocks, which obviously CRM is a tech stock, right? Software company, things move rapidly. And when a stock starts a move, when it's a tech stock, it goes quick, man. Look at, for instance, Google. My Google position, I started that on April 23rd. It's already up almost 53%. Quick. And a lot of that move, honestly, has come in the last 1 month. The last month. And the reason stocks like tech stocks move so quickly is the narrative can change so quickly. From like Google had a narrative around it like a few months ago of like, oh, the government's going to tear them apart. Oh, ChatGPT is going to own them. All this stuff, like all these narratives. Oh my gosh, they were just throwing them at Google. And then the narrative changed. And what happened? The stock appreciates 50+% in a snap of fingers. It happens so quick, right? So with CRM right now, that company's dealing with a lot of negativity. Oh, they're going to be disrupted by AI. Oh, all these companies are going to build out products that compete with Salesforce and their own in-house products, and they're going to have AI doing all those things. And it's like, whatever. Like, believe whatever you want to believe, but that's likely not happening. Okay. Salesforce is so entrenched in these companies. Good luck. You want to, build something in-house that is better than Salesforce? Good luck. Or something comparable is likely going to end up being a disaster. I heard something like, a stat recently I heard was something like 94% of projects were just complete failures that people were trying to do in regards to this. Okay. Another stock that's moved huge is Oracle. Look at Oracle. Its stock was $105 back in the fourth quarter of 2023. Now it's $300 plus stock. These stocks move rapidly. Another good example is Avago, Broadcom here. Broadcom, you look at that one back August 31st, 2023, $83 stock. Today's $369. Now, this does not mean that Salesforce is going to 3x or 4x in the next, 2 years or something like that. But the moral of the story is when you have tech stocks down and out, you have to build the positions rapidly. You don't have all the time in the world. People think, I have so much time. A lot of people thought that in 2022 and they were all wrong. You looked at Meta at $88 and people were like, no, it might go lower. I got time to buy Meta, right? Next thing you knew, Meta was 200 plus. And you're like, crap. I never started my position. What am I going to do? And then Meta was like 300 plus. And you're like, what? And then it was 500 plus. And then it was 600 plus. And it was 700 plus, right? And soon it's going to be 1,000 plus. So things move rapidly when it comes to tech stocks. You don't have all the time in the world. You see a great opportunity, you got to pounce. And you got to add that position as quickly as possible over a few months, and then you let it ride. And if you're right on the stock, like, it's going to go up massively, right? Now, Salesforce, I don't want to go super back in depth with Salesforce because I talked about a lot just in this past week on the main channel. There's one point I'm going to make that I'm going to show you guys in regards to AI cycle that I haven't made in these previous videos. But if you want to hear me talk very in depth about Salesforce, watch this video I produced a couple days ago called 7 Stocks You Must Buy Before 2026. Or you can watch this stock from 6 days ago. I bought a new stock today. You can watch those videos, check those out if you want to hear more in-depth talk about CRM, Salesforce. But this is a point I haven't made in regards to Salesforce that I think is an important point I need to make, okay? Because people don't understand. They look at this AI cycle and like, what's going on here? Like, these chip companies like NVIDIA are just booming, right? Broadcom's booming. AMD's just at the very beginning innings of booming. And they're like, but why is anybody actually making money from all these chips that are being sold other than the companies that are selling the chips, right? And so far, it's like very, very minimal amounts of money are being made from most companies, right? But you got to understand about this AI cycle is it started all in 2023. And, very shortly into 2023, what happened? NVIDIA's revenue started to skyrocket. And then they skyrocketed more, right? And then basically this chip cycle around 26, 27 will, I would say more toward 27. In 27, the chip cycle will start to more flatten out. That does not mean no one's going to buy AI chips moving forward. That doesn't mean there can't be some slight growth in AI chips after 2027. But the crazy increase is like going to start seeming like almost like a flat line for the chip cycle part of this story, okay? But what we're seeing is, if you look at really revenue that came through for companies that were non-chip related in doing AI projects, I mean, it was almost nothing in 23, 24, right? Because everybody's spending on these chips to hopefully make a bunch of money off them. But you got to buy all the chips. You got to get them all installed. You got to get the products built. It's like a whole site. It's a whole process. It doesn't just happen overnight. Like, I'm going to buy a bunch of NVIDIA chips and then I'm going to just make so much money the very next day. No. Then you got to worry about marketing and selling those products, getting them out to the customer base. It's a lag. There's a big lag here. So if you look at 23, basically it was almost no one was benefiting from AI cycle outside of NVIDIA in 2023, right? Then 2024, you might have started to see a very early glimpse of some companies like Meta started to, recognize like AI is starting to help them make more money by feeding people videos or pictures or things like that keep them on the platform more often. That means they see more ads. Advertisers have better results. So you started seeing very early. 25, we've seen a little bit more, but I think 26 and after is when things really start to take off in regards to software and AI and companies that are non-chip related, making fortunes of money from this, okay? And the thing is, when it comes to companies that are going to make money from software and AI and other companies, it's not going to stop. That's going to keep going for a long, like we're going to be talking about, that's going to skyrocket all the way likely into the 2030s because of how big the lag is here. Like these companies aren't just going to like sell their AI products 1 year and it's done. No. All these companies are really going to be on monthly recurrings or yearly recurrings. And then they're going to keep marketing those products, selling them to more and more customers, more and more companies, getting them in, going up on the prices over time, right? As customers begin to see more and more value. And that's a cycle that's like way longer than the chip cycle. The chip cycle is great, right? And this initial wave is going to be massive. Like, NVIDIA's revenues, AMD's revenues in 2027 are going to be just ridiculous, right? But you're going to see revenue growth start to slow a lot, 2028, 2029 for companies like that. And AMD is a big major investment of mine, right? And that's fine. Like those companies don't have to grow at, the sorts of clips they're going to be growing at. Certainly NVIDIA over the past few years and in AMD over the next few years. Like that's not sustainable forever. But on the software side, oh my gosh, in my opinion, on the software side, inning 1 starts in 2026. And then we start going from there and there and there, right? We're already getting the early signs of non-hardware big money coming. Look no different than Palantir. Palantir's already showing you the early signs of like, hey, there's money to be made out here if you got the right products, you know how to market it right. And Palantir's got the right products and they've marketed phenomenally, right? And look at their revenues already. Went from 30% revenue growth to 36%, 39%, latest quarter 48%. And now the question is, where's Palantir revenues top at? Is it at the 48% number or are they going 50% plus? So, they're already, Palantir's already hint, we're showing you the way, right? If you look at somebody like Salesforce is already showing us the early signs that it's coming. If you look at their latest numbers, data cloud and AI annual recurring revenue, $1.2 billion. Such a small number compared to the overall revenue Salesforce does. It's $40 billion plus of revenue is expected this year, right? So it's like 1.2 billion, it's like nothing of that. But the growth was 120% on a year-over-year basis. They're going to be able to grow triple digits for a while. And then we're going to be talking about insanely strong double-digit growth. So Salesforce is already giving you the signal like, hey, we're going to make a lot of money from this stuff. Like, look at the growth rates we're putting up. Look at how fast the revenue's building. Palantir's already given everybody but the thing with Palantir, everybody gets it already. Everybody's like, okay, they see it. The stocks obviously reflected that, right? People don't see it in regards to Salesforce yet. They will see it. And the reason they see it so easily with Palantir is the overall revenue growth. With Salesforce, because the component of the business that's growing so fast right now is such a small number, people don't see it yet. They will see it in 26, 27, 28. And that's why I need to build out this position rapidly, okay? So Salesforce, I love this one. And I'm going to continue to buy it. I'm going to make it a massive position likely in the public account. I'm going to probably build the position in other portfolios as well. And then we'll let the chips ride and we'll see what happens. I think I'll be right on this one. I think I'll make a ton of money. I think it's going to be very anti-stressful. And I think it's going to be very exciting. And whenever you got Benioff leading a company, it's usually very exciting, okay? Stock number 2 of 3 I bought here today is NKE Nike. Bought another $1,700 worth of Nike in the public account. $74.16 I paid for those shares there. 23 shares more as far as Nike goes. Continue to build that position. Now, I spoke about Nike in this video here, 7 stocks you must buy before 2026. I don't want to go back over my whole bullish thesis in regards to Nike. It was one of those stocks I spoke about in that video there. So if you want to hear me talk more about Nike, you can watch that video. Now, an important subject I got to say in regards to Nike, and this is not something I've publicly discussed yet, but I got to say this. I'm done buying Nike at the end of this month. We're almost to the end of the show. So here's the deal, okay? I own 2,800 shares in Nike. It's over a $200,000 position, and it hasn't even started going up yet. So it's very meaningful. Remember, the public count's a little less than $4 million portfolio, right? So a $200,000 plus position in that portfolio is very significant when you factor in, we haven't even started getting the gains yet on this stock. So as the gains come, if I'm right on Nike over the next several years, right, it's going to become even a bigger position of the portfolio. So likely after October, basically October and after, I'm not buying more of the stock. I'll be good on what I have. That doesn't mean the stock's not a buy anymore. It's still going to be a buy in October, and it's still going to be a buy in November, and it will still be a buy in December. I'm just not looking to add more shares. And so Nike has my full blessing. If it wants to start going up October and after in 2026, go for it, because I'll be done buying it across all my portfolios. I'll finish off my position buying basically at the end of this month, essentially. No, this is a very important, you might say, well, but you have so much conviction in Nike, right? You believe it's going to go up, right? Well, sure. But you can never get too overexposed to a position. It doesn't matter how, somebody's been in the game 17 years. Listen, man, you can't go too heavy on a stock. You got to stay diversified. You go too heavy and you're wrong, and sometimes you're going to be wrong, it could be devastating in your portfolio. It can set you back between 1 and 4 years, depending upon how bad it is, right? It can set you back between 1 and 4 years. For instance, I got overexposed to a chef back in 2022, right? And then, so that set the portfolio back quite a bit. And so from my 2021 high, it took me all the way into, I think, the end of 23 or the beginning of 24 to get back there, because I was way overexposed to a stock that didn't work out. That's why you can't do it. You stay diversified in this game. Doesn't matter how sure you are. Doesn't matter about this is the next 10x opportunity, right? And by the way, Nike's not the next 10x opportunity. I just think it's a stock I'm going to make a lot of money in over the next several years and be able to hold it for a long time to go in the future and be very anti-stress stock, right? Pay me out big fatty dividends, buy back shares, continue to build the business, get the profitability back, get the margins right, and it's going to be fun. But you can't get overexposed. Otherwise, you set yourself up for a big problem. AMD is a perfect example of this. You know how much I believe in AMD. You know I believe AMD is going to $300 to $400 stock over the next couple of years here, right? Yeah, I think it's going there. Do you see me get overexposed to it? No. I own 2,555 shares. It's a $400,000 plus position, right? But if you factor in my cost basis, it's actually less than a $300,000 I put into AMD. And yeah, I believe so much in it. I think the stock's going to be a beast, but it's a perfect example of a maxed out position, okay? Meta. Meta. $1.2 million position. I think Meta's going to 1,000 plus within the next 12 months. I'm not adding more Meta in the public count. I'm already overexposed. And just because I think it's going there doesn't mean it's going there. I think there's a lot of stocks that are going up over the next 12, 24, 36 months, right? Alrighty, guys, stock number 3 of these 3 stocks up here is HMST Honest. Bought 777 shares here today. $3.82 I paid for these ones. If you don't know Honest, some would say it's a boring business model. Diapers, wipes, soap, shampoo, makeup, all that sort of stuff is what Honest sells. And they've got a great niche market in regards to business. This is a trailing 12 month, looking at 1000xstocks.com. This is a trailing 12 month of revenue. This is where we're at right now. This is where we're expected to go. So nice revenue growth. Carla's done an amazing job turning this company around. Look at the margins. Look at the margin increase. From margins, gross margins that were in the low 20s to now pushing 40% plus. Gross margins. And we don't even know where the top is. Like maybe this was a top, maybe we're not going to do any better than 40%. Or maybe Carla's going to keep going here and we're going to be talking about this company's going to eventually get to gross margins of 45, 50%, which would be pretty insanely impressive for this category. Look at net margins. That's bottom line margins, right? They were like off the chart. It was so bad before Carla took over this company. And look at the net margins since. Unbelievable turnaround with this company, right? Look at how ugly that earnings per share was. Carla takes it over, already starts making massive improvements, and now we're talking about a company that should be profitable moving forward. Huge. Balance sheet's a beast at this company. They're loaded to the sky with cash, right? No debt on this balance sheet. The shareholder equity's booming for Honest. Now, the one thing you could maybe poke at with Honest, other than like, it's a boring stock, right, is shares outstanding. And I understand that, like shares outstanding have gone up over time. But here's the deal. I think they could do a big buyback in 26. The reason being is they should be profitable in 26 and after. Like, you know, it's just a question of how much in profits they're going to pull in a year. I think that's really the only debate. But then additionally, you look at the cash balance on the company, and I think the company could easily do a $20 to $50 million share buyback next year, which for a company with a $400 million market cap is a lot. And you know what that's going to do to the earnings per share of the company in future years? So I like Honest. I like it a whole lot. I know it's supposedly a boring stock and a small cap and all that, but I think there's a lot of money to be made here, and I think we'll be out of the gulag shortly, and then I think we'll be talking about $10. But we'll see. We'll see how it all plays out. If Carla keeps executing the way she's done, we'll be out of the gulag very shortly, and we'll be up into $10 before you know it, okay? Congratulations, everyone out there closing their portfolios today at an all-time high or close to an all-time high. It was definitely not too far off in regards to the public account here today. Well over $3.9 million in the public count. I got a very important subject I want to speak about at the beginning of this video, very serious subject. A problem I see out there in the market, retail investors. I need to speak about this and make sure that point's really understood out there. So I want to speak about that at the beginning of the video, okay? From there's a couple of videos I want to go ahead and react to. One is Dan Niles here speaking about don't confuse stock prices with company fundamentals. I'm looking forward to reacting to that one. Then I want to react to this one. AI-driven bull market will continue, but a near-term pullback is likely, says Julian Emanuel. Looking forward to reacting to that one. From there, I want to go ahead and show you guys, I'm just going to drop some gems in regards to running projections on a company. And the reason being is I was showing some projections in this video I did last night, 7 stocks you must buy before 2026. But some people didn't understand like how to run projections or how it works. And they're like, why is this number like this and this number like that? You know, and I understand there's a lot of new people in the market that haven't been doing this a long time. So I'm going to show you guys how to properly run projections in this video and how to actually think about this as a long-term investor in the market. Okay, so I'll actually run projections live for you guys in this video. Okay, and then the last subject I want to speak about here today is these, like, let's call it fast casual type stocks are getting obliterated. Chipotle down 34+% year to date. Cava down 42% year to date. Sweet Green down almost 75% year to date. We're going to talk about if there's opportunities in those stocks and if this is a time period you should be buying or it's a time period to stay away. So hope you guys get a lot of value out of today's video. I appreciate y'all for joining me for this one, very serious one. And like I said, I got some gems to drop for you guys, some reactions. This is going to be a great video overall. So I appreciate you. One thing only I need from you guys. If if you haven't already done so, and I appreciate everybody that's already done it, and I don't even need to say it, but for the people that haven't done it, please hit the like button on this video. That's all I need from you. If you could just do that, that would mean the world to me. If you want to be subscribed here to the channel, you can certainly subscribe. We are now, I think, 108,000 subscribers, 107,000, somewhere around there. Okay, I appreciate y'all for being here. So I want to talk about a very serious subject at the top of this video and an issue I'm seeing. Okay, so listen, I have seen recently Joseph Carlson's getting some hate in regards to Duolingo stock. So Duolingo stock obviously hasn't done well. We all know that, okay? But I have an issue with this, and I have an issue with people talking crap, waiting for somebody's downfall, and for what reason? You know what I mean? Like, Joseph Carlson had a ton of successful stocks over the last several years, right? Let's say he gets Duolingo wrong. Let's say, you know, it doesn't work out. Let's say Duolingo's wasn't the one, right? And let's say it's, you know, 2-3 years in the future, and Duolingo's, you know, same prices today, maybe lower, maybe $100-something, right? And let's say he was wrong on that. Okay, big deal. Big deal. What does it matter? Like if you understand, in this game, you're never going to bat 100%. Ask any great investor who does this over 10, 20, 30, 40, 50 years. They all tell you that. You're never going to bat. I've been in the market 17 years now. There's been plenty of stocks I've gotten wrong in the last 17 years. Some I got wrong in the respect of I didn't see the future and I didn't invest in it, and it was like the next big opportunity. Some where I invested into it, I thought it was the next big opportunity, I lost a lot of money. That's a cost of doing business as being an individual stock picker. And you have to accept that. No, you want to try to minimize as many mistakes as possible and try to have as many successes as possible. No doubt, right? But what good does it do to tear down somebody else? Like, does that make you feel better? Like, that's just crazy to me. But you got to understand, there's people that have been waiting, you know, to tear him down, right? Just like there's people waiting to do what? Tear me down. So, you got to understand, back in 2022, I got torn down. They shredded me out there, right? Everybody made fun of me, you know, and I understand, like, some of it was my fault, and then some of it was the market. Like, the market, you know, peak to trough, NASDAQ fell like 37%. I was getting obliterated out there. It was like everything I touched was going down, pretty much. I mean, Meta went down to $88. You know, my small cap stocks sucked. Like, it was brutal. I was getting brutalized, and everybody came. I don't want to say everybody, but a lot of people came for my head, right? And a lot of people had been waiting on that date. And the reason being, I had been hot in the market for several years and I had a lot of success. I'd made a lot of money on stocks, including obviously Tesla, right? I was able to capitalize on that massive move, in Tesla stock, all the way from like, it was like a, $15, $20 stock all the way to like 400. It was unbelievable. And so a lot of people have been waiting for me to, have a tough time. And I had a brutal time. I don't think, I'm hopefully setting myself up to never have that brutal of a time again, like I had in 2022. But the moral of the story is, like, the next bear market, there's going to be plenty of people that, are going to be hating on me, making fun of me, and I'm going to see who's out there for me. Because it's always in the bear markets that I see who's really riding with me or who's not. Because at the end of the day, like, there's people watching this video right now that can't wait for my downfall. Literally right now. And the thing is, a video like this might get 70,000 people to see it. Like, I don't know how many people will watch this video, but let's say 70,000. That's probably like the average for this channel, right? Of that 70,000, I think there's probably about 1,000 people watching this right now that are waiting for my downfall, that are waiting for my stocks to suck, that can't wait to make fun of me, that are going to be leaving nasty comments, making fun of me, that are going to be engaging in all that sort of stuff. And it's crazy, because what good does that do for you? It does no good for you. It's not good for your mental health. It's not good for your wealth. It's not good for anything. And so, but you gotta understand, like, there's people waiting, and they're waiting, and they're waiting. And the next bear market, when my stocks are going down, my portfolio is going down, believe me, they're gonna be out there to make fun of me and talk trash on YouTube and talk trash on X and all this stuff. So just understand that. And we'll see how many of you guys are there for me, when that time period comes. And so when I see that Joseph Carlson stuff, making a big deal about this, and they can't wait to, attack him for this, I'm like, dang, man, the guy's had so many successful stocks over the last few years. And yet, this one he might get wrong, or it's going through a troubled time. And look they were just waiting. They were waiting to pounce, right? Now imagine if he has a second stock go bad. Oh my gosh, it's going to be, it's going to be nasty. And I have such an issue with somebody like that. You know why? Because somebody like that is actually preaching good fundamentals. They're preaching good fundamentals. They're not giving you some pie in the sky thing about like, oh, this company has no revenue, but someday it might do a lot of revenue. Like, they're not giving you some crazy, like, you know, ridiculous stuff. Like, he's just, if anything, Joseph Carlson, some people would say he's maybe investing too boring of stocks. Like, if that's your criticism, like, okay, that's not the worst criticism, right? And so that's a guy actually teaching good fundamentals. You know, I think he's got his head on straight. I've watched plenty of his videos over the last few years, and I'm like, of the people, you know, you could go after, I'm like, really him? Like really him? You know, there's a big difference between somebody like him, right, and somebody like a Cathie Wood, right? Cathie Wood, you know, look at this. Over 100,000 people watched her latest video from 3 days ago. Now her views have dropped off a cliff. Obviously, she used to get like 1 million views or 800,000 views a video, 500,000. It was just ridiculous, right? But Cathie Wood's actually somebody that deserves a lot of criticism. You know why? Because Cathie Wood's 5-year performance with ARK is down 10%. So if you invest in ARK the last 5 years, you've lost money. And this is a woman that is supposed to be a professional investor that, you know, is running an ETF, gets platformed. Like, how many times have we seen her go on to CNBC and Bloomberg and all these different networks and, like, you know, platformed like this in massive podcasts? And for what, negative 10% over the past 5 years? Meanwhile, the S&P 500 has gone up 94%. The QQQ has gone up 114%. Like, if there's somebody that deserves some criticism, like, that would be a person that deserves some criticism, you know, somebody that's preaching crazy stuff and has those sorts of returns over time, right? So, you know, and another part that I got to bring up here, right, is Tom Lee. Now, the thing with Tom Lee is, and this is a subject I want to speak about here before we get into those reactions and I take you guys through how to run projections properly and all that good stuff. But, you know, Tom Lee, there's an issue here, okay? Tom Lee makes a lot of big, bold predictions, okay? Bitcoin can easily get to 200,000 before year end, right? What was it? Wasn't it last year? You guys that follow me religiously on the reaction channel, what was it? Was it last year that Tom Lee said something to the effect of, you know, small caps are going to go up like 50%. Remember we were reacting to that here on the reaction channel? You guys can refresh my memory on that. If I recall, he was making some sort of call that small caps are going to go up 50%. That never happened. Okay. Tom Lee makes a lot of big predictions. Some come true, some don't come true. Okay. But he makes a lot of big predictions. And the issue we have here with somebody like a Tom Lee, right, is, you know, everybody loves him for his bold predictions in this sort of market that we've been in, right? But believe me, when we go through this next bear market, whether that starts in 26 or 27 or 28, whenever it starts, or this year, I don't know, whenever that bear market starts, just understand Tom Lee is going to get a level of hate that, you know, it's going to be pretty extreme. So just do understand that, folks. And it's not my first rodeo in regards to seeing this. I've seen this play out before. I just watched it play out a few years ago. You understand, Tom Lee was loved in 2021. And, you know, by the halfway through 2022, he was getting obliterated, right? Everybody was making fun of him, calling him names and saying this and saying that. So the biggest thing that I want you guys to take away from this, okay? The biggest thing, let me pause this, landscapers are here, and then I'll restart, and I'll tell you guys what the biggest takeaway I want you guys to take away from this is. So the biggest thing I want you guys to take away from this is do not, I repeat, do not engage with this behavior that is rooting on people's downfall, that is hating on people, because it will do absolutely nothing good for you. You know, I'm a big believer also in karma. I've always been a big believer in karma, like a huge believer in that, and the way you treat people, you know, when they're down and when they're up, you know, and those sorts of things, right? And how that comes back around. And I don't know, maybe there's something to that. Maybe there's nothing to that, right? But I'm a huge believer in karma, right? And I've seen some people treat some people very bad, and it comes back around to really bite them. And I've seen some people, you know, handle tough times really well and not take it out on others. And those people end up actually doing very well long term, essentially, because at the end of the day, what you can control is your income, your expenses. What you can control is, do you invest in yourself? What you can control is where your money goes. What you can control is running projections on stocks, doing research on stocks, running your portfolio. You can control all those things. You cannot control whether the stock market goes down or up in the short term. You can't control whether a stock goes up or down in the short term, right? You have there's nothing you can do about that. Like, that just is what it is. And you can also control whether you engage into activity that is like hating on others and rooting for them and rooting for their downfalls and all those things like that. Like, it's just not behavior you want to engage in. It's tough to get places with that sort of behavior. So keep that in mind, folks. Take that with you, and let's make sure we're not doing that sort of stuff. Okay. Alrighty, next up here, let's react to a Dan Niles video here on the market, and then we'll react to this one, Julian Emmanuel.
Great to be on, Melissa.
It certainly doesn't seem this way, that there is an adoption slowdown when you go through earnings calls, when you hear what companies are saying, but there could be a difference in what they're broadcasting versus what is actually going on in terms of dollars spent. What's your take on this? Because there's always that concern that there's a pull forward, that the expectations were just being bloated to begin with, and that it will catch up with this trade.
Yeah, I think the tough thing is, don't confuse what stock prices are doing with what's actually going on fundamentally, because those two things can be completely different for short periods of time. And that's what you have going on right now. You were talking earlier about, the Fed cutting rates, starting again that cycle on September 17th.
Oh my goodness, these landscapers are something else. This is the whole situation going on.
Rates starting again that cycle on September 17th. And that's driving these stocks up. But if you listen to what is actually coming out from these companies, it paints a slightly different picture, right? Where, remember, there was an MIT study that came out that 95% of companies weren't seeing any, improvement from their spending on AI. Then you get to company actions, which matter more than these surveys, and you go, all right, Meta, which has been absolutely killing it with their Llama models, now there's talk that they're going to work with either Google or OpenAI to get Llama 5 out. And after spending Major League Baseball pitcher type salaries for AI researchers, they've probably now restructured their AI team at least 4 times in the last 6 months. You look at what's going on with Apple, right? They announced all these AI features for Siri in 2024, but it'll be probably 2026, and they're going to have to work with OpenAI or probably Google following this antitrust ruling to get those features out. So you are already seeing this, and over the weekend it came out that OpenAI has sort of pushed up their revenue forecast for 2030 by about $26 billion to $200 billion. But to get that revenue increase of $26 billion, they're going to have to burn $85 billion more in cash. So the data points are definitely there, but we're in this business to make money. So you have to go, all right, well, do the fundamentals matter right now? Or is it the fact you're going to get even more easy money? The 10-year yield's going down to 4%. And so this market, much like in 2021, will keep going up right up until it doesn't. And so I think you have to look at that. And NVIDIA missing on data center revenues. And you can say, yes, but the growth was so high and all this, but they missed. So that should give you another data point, and you throw on top of that Dell or Marvell, or the fact that Avago's got more ASIC revenues because companies want to cut their costs. Those all speak to the same narrative. So don't confuse the actual data with what the stock prices are doing.
Dan, I think, people who are believers, who are basically...
So let me just push back against Dan Niles for just a moment there. Okay, listen. In regards to NVIDIA, here's the deal. You can't draw too much of a conclusion from one quarter. You got to see a trend, right? You got to see a trend. If you see next quarter, they also missed data center revenue, or let's call it barely come in line. Ooh, okay, now you got a problem with NVIDIA. One quarter, next quarter, don't be surprised if data center revenue comes in and smashes for NVIDIA. Do not be surprised at all. So, you got to understand with NVIDIA, there's going to be a time when NVIDIA is going to be having really troubling numbers, but that's still like a year to year and a half out. And when I say troubling numbers, like almost any other company would take those numbers, but what it's going to be is it's going to be really slow growth rates. But that's still like a year to year and a half out, in my opinion. So, the death of NVIDIA and NVIDIA stock has been greatly exaggerated. Like I continue to say with NVIDIA, it's just range bound, and it's going to remain range bound for quite a while, in my opinion. It'll push when people are feeling real bullish around NVIDIA, right? Let's say they come out next quarter and data center revenue smashes, stock goes 200-ish range. And when people go bearish over the next few years, the stock will go down to probably 125 or so. And so I just feel like the stock for years is going to be stuck in this like 125 to 200-ish range, and it's just going to kind of be somewhere in there, and that's going to be for the next several years, in my opinion. And so, once again, people go bullish, going to push up to that 200 range. People feel bearish, going to push down to the 120, 125 range, and that's just going to be the game. And I think that's the game for the next several years with NVIDIA stock. And so that just is what it is.
Not committed to this whole CapEx story will say, well, sure, companies are not yet seeing the benefits, or they're not yet accelerating their adoption of various AI tools because we're not there yet, and we have to build as fast as we can to get there. The market's permitted a lot of these companies, the entire infrastructure trade, to go pretty far at this point. Is there any sign that the market's going to kind of tighten the reins on that?
Well, number one, I would disagree with your premise that, it's okay to not see returns. We're 3 years into this, Mike, right?
I didn't say it's okay. I'm suggesting the market's been okay with it.
Hold on, Dan Niles. We're not really 3 years into this, in all due respect. So this AI cycle started to take off at let's call it in 2023. Right? So that's when you started seeing the first big orders of AI chips roll through. Okay. So then last year was a let's call it an uptick year, and this year's a further uptick year. Like, if you're on the side of trying to make money from AI, here's the deal. Like, you're way too early in the cycle to really be showing any meaningful returns yet, unless you're somebody like a Meta or maybe a Google, somebody like that that's already got it, or ChatGPT's seeing returns on obviously their investment and whatnot, right? But like, you're still too early in regards to like having to see a return right now. A lot of these software companies, like even a Salesforce, for instance, right? A lot of their big, let's call it, increases of revenue will come in 26, 27, 28, 29. Like, that's all still rolling down the road. Palantir's obviously started to see a very meaningful uptick in regards to their revenues. But it's a game that's got to play out. To say it's 3 years, a little bit false, in my opinion. We're more like a year and a half to 2 years into at least having an ability to start to generate some revenue from these chips you're buying and what that ends up producing at the end of the pie.
Well, but again, that kind of goes back to the fact that we're looking at rate cuts coming, right? That's been the number one driver of this market really since COVID, and you can argue since Lehman failed, right? So, you have inflation going from 1.4% to 2%. 1.4 to 7% in 2021. The S&P is up 27% because the Fed keeps telling us it's transitory, when I think a lot of people, including myself, thought it wasn't. Then 2022, you admit to it, rate cut.
I got to push back against Dan Niles again. I love Dan Niles, but man, I got to push back against this. Hold your horses, Dan Niles. What he just said there was just preposterous, just ridiculous. The main driver of this market, since even Fannie has been rate cuts and rates. No, in all due respect, Dan Niles, it's been earnings. Same thing that since COVID. He spoke about COVID there. Since COVID, it's been the main drive. No, earnings. Have you seen what's look at Apple's earnings per share before 2020. Look at their earnings per share now. Look at Google's earnings per share before 2020. Look at Google's earnings per share now. Look at Meta's earnings per share before 2020. Look at their earnings per share now. Look at NVIDIA's earnings per share before 2020. Look at it now. Look at Amazon's earnings per share before 2020. Look at it now. No, nothing about rate cuts. The driver of this market since Fannie Mae and Freddie Mac in 2008, 2009, and the driver of this market since Rona has been earnings, in all due respect. Nothing about rate, that's irrelevant in the conversation, just to be quite frank. Irrelevant.
Hikes happen, the market gets beat up pretty good. 2023, the Fed goes ahead and goes on hold. This year, and the market's obviously surges over 20% this year. Looks like rate cuts are coming. Market starts going up. And so that's doing a lot of this driving of it, and that's why it makes it seem like people are okay with this, because don't forget, NVIDIA is down since they reported. Obviously, it surged a lot off the bottom, but don't forget, like middle of last year when Microsoft, Google, Amazon all had CapEx spending going up while the revenue estimates were actually getting cut. NVIDIA went flat, went sideways for the last half of last year. So, this is a point in time. The rate cut's in front of us. That's why if you see a lot of the things that I write, it's, forget about valuations, forget about fundamentals. It's all about easy money. And the party's going to continue right up until it doesn't. My thought has been that's around Thanksgiving when, we find out there has been a big pull forward in demand. But in the near term, the goal is to make money, right? And then being intellectually right, that's something that ultimately will help you make money on the other side of this by being short a bunch of stocks. And I think we're getting closer to that. But for right now, it's stay long and make money.
So Dan Niles says, for now, stay long and make money. So that's his perspective. Okay, next one up here. AI-driven bull market will continue, but a near-term pullback is likely, says Julian Emanuel.
It's a buying opportunity, especially for AI-driven leaders. So here with more is Evercore's Julian Emanuel. We were speaking about this earlier on the show. I don't know if you had a chance to listen, but for so long, AI seemed like a buzzword, and all you had to do was just drop it here and there in an earnings call, and you got a little pickup in your stock price. But now we need to really see some of those gears turning. We need to see what it means to actually be capitalizing on AI. What should we be looking for here, even if you see some choppy movement before we really take off?
Yeah, and look, again, if you think about it within the context of the last great technological revolution bull market, the internet of the late 1990s, choppy movement is part of the script. And so in that respect, considering we've gone up almost uninterrupted since the April low, which itself was a scary chop, as we know, it's to be expected that we might have a little bit of indigestion, particularly September into October, when we've got uncertainty. We're going to have a payroll revision number tomorrow that everyone is sort of focused on. And again, the inflation figures, tariff rulings from courts, all of these things together. But what we're looking for specifically is the continuation of this dialogue from corporate America in general that we've heard for the last several months, that they're actually becoming front foot on talking about how they're using AI to generate revenue, not just the cost save, it's the revenue generation. And you're seeing it across industries. And for us, that really bodes well for the setup into 2026.
It's interesting because Sherry Paul from Morgan Stanley was on earlier in the show, and she said, yes, of course, there's tariff noise. There's other macroeconomic uncertainty. You're talking about CPI and PPI and maybe a jobs revision. But she says that doesn't really matter so much because innovation is where it's at. You got to stay focused on AI. But you're sort of saying, yes, but we could be choppy getting there because of those macroeconomic headwinds. But basically, you're saying, hold tight, use the opportunities.
We are, because again, going back to, and if you think about sort of February, March, and April, great bull markets, and this is a structural AI technology-driven bull market, great bull markets find ways to try and to get investors to get off the theme, to do some selling. And our feeling here is you don't do that because basically, when you think about it, what really drives stock prices higher in the long term is earnings. And we're very optimistic on earnings into 2026.
Okay.
So, what do I feel about near-term pullback here? So, listen. You can stress yourself out so bad about near-term pullback, when's the perfect time to buy, all these sorts of things. The bottom line is Google going to be a lot higher 3 years from now, 5 years from now than it is today? Where do you think their revenue is going, their net income's going the next 3 years, 5 years? What about Amazon? What about Meta? What about AMD? Like, run your numbers, run your projections, look at the valuation. We're about to run projections here in just a moment. Don't stress yourself out too bad about if the S&P 500 is about to go up or down the next 5-10%. Because I think Warren Buffett or Peter Lynch or somebody famously was quoted saying, I can't tell you where the next 10% in the S&P 500 is, whether it's up or down, but I can tell you where the next 90% gain or the next 90% move in the S&P 500 is, right? It's higher. And so 100%, whether we have a 10% pull down or 10% up move, who knows? But the next 90% is higher. The next 100% is higher. The next 500% is higher. It's up. So just something to keep in mind there. So let's do some projections. And once again, this is on the back of this video I did on the main channel last night called 7 Stocks You Must Buy Before 2026. I was showing some projections in that video, and some people didn't quite understand like how running projections works and like what matters and doesn't matter and those sorts of things. Okay, so we have 2 different projections on 1000xstocks.com. Okay, now if you want access to this, you can always go to 1000xstocks.com. You can apply for access. Also, the pinned comment down there is if you want to apply for access to my private stock group plus 1000x access. Okay, but we have 2 different ones. This is intermediate projections, which is where you run a bull case, base case, and bear case on a stock. Okay, and then we have another one which is called advanced projections. Now this one goes crazy. Okay, this one you can adjust revenue growth, cost of revenue, you get your gross profit margin, your operating expenses, how much you think that's going to go up or down over the years, operating margins, other expenses or income, essentially, your net income margins. Then you can basically, if you think there's going to be big share buybacks for a stock over time, they're going to take shares off the market, you can adjust for that. If you think there's going to be major dilution for a stock or minor dilution, you can adjust all those numbers. Listen, I think for like 90% plus of people, this is a little much, okay? And then you run your projections all the way out to 2030. So what we're gonna stick with is intermediate projections for this video, and I'm gonna show you how this rolls. But we have this for advanced people that, you know, because we have a lot of private stock group members that, you know, some are newer to the market, as in they've been in there, you know, just in the past year, last few years. And we have other people that have been investing for 10, 20, 30, some even 40 years. And so they love the advanced projections. Saves you so much time. And you've got to run projections on stocks. If you don't want to use 1000xstocks.com, build your own projections in a spreadsheet. That's a great place to start if you're not ready to, you know, join something like 1000x. It's a pain because you got to build it, you got to make sure all the calculations are right. Then you have to manually import numbers. It's a pain. Whereas something like 1000x, like we automatically import the numbers. So let's say like Apple, like watch. Boom, Apple automatically comes up with their expected 2025 revenue and net income, right? So the numbers are already there, net income margins are earnings per share. It makes your life so much easier. You know, if you're manually doing this, you got to enter it all in, and then you got to have all your different cases. It's a pain. It's like, this is like, it saves me so much time. It's ridiculous, okay? So here's a way to like think about this, okay? What stock do it? Let's go with a stock like Meta. Okay, let's run projections on Meta. Okay, so here we go. Boom, it auto-populated the revenue, the net income margins that are expected this year, all that good stuff. Okay, so whenever I run my projections, I'm not trying to cherry pick a revenue growth rate exact on a year-by-year basis. So like, I'm not trying to say like, oh, Meta's going to grow 20% this year, but then they're going to grow 15% this year, and then 17% this year, and then 11% that year, and then that changed the PE ratio. No. Okay, like, no. I'm not going to. I want to be directionally right. I don't need to be exactly right. I don't need to be like, oh, in 2029, they're going to have 13% revenue growth. No, I want to be directionally correct in regards to a company like Meta, okay? And that's the same thing. And so when I run my projections, I want to just put an average revenue growth I expect for that case over the coming years, an average net income I expect over the coming years, and what's an average P ratio that I think the stock should probably command come 2029. So people sometimes look at the 2025 and 2026 and they're like, wait, you think the stock's going to be lower? Dude, I'm not even looking at that. It's so irrelevant. I'm not investing in a stock for what it's going to do in 2025, 2026. I literally don't care. Like, whenever the stocks I'm buying right now, I could care less what they do in 2025, 2026. If anything, I hope they go down. I'd much rather buy more shares for cheaper. And if you don't understand the concept like that, we got to get you, rolling here in the market and understanding like very simple concepts, right? So I'm really running these projections to see where this company is going to likely be at in 2029 and what's my CAGR between now and 2029. That's what's important to me. So somebody like a Meta, I'll run them at probably on a bull case, I'll run them at like, let's say like an 18% revenue growth rate for a bull case. I think that's a very fair number for average, right? Now they should be able to grow net income at a much faster clip. So I would say somewhere at least maybe 23% net income growth on average per year under a bull case assumption. Now, if you're growing top line 18%, bottom line 23% for a company like Meta, they should probably be able to command, I would say, somewhere between about a 29 and a 34 PE ratio for a company growing at those sorts of rates. They should honestly command higher than that, but it's Meta. So it always has trouble commanding a super high valuation. So under a bull case assumption, I'm looking here. I don't care what the stock is, projected this year. This is irrelevant to me. I care what the stock is likely projected at here, right? So this puts the company at $384 billion come 2029 for revenue, $165 billion net income. That number's never going to be exact. But it's, if a bull case plays out here, it's going to be directionally right? 43% net income margins, right? Gives me a CAGR on the low end 25%, high end 31%. Now my base case is a little more conservative. I'll go about 16% revenue growth on average per year for Meta over the coming years. I'll take that net income growth to about 20% for this particular case, and I'll go down to about a 25 to 30 range for Meta under this particular case, and we'll see what Meta is going to give me for a CAGR here. So under this assumption, basically I should get a CAGR of around 20% a year through 2029 under my base case assumption for Meta, right? Now, once again, I don't care what the stock says in 2025, I'm not even looking at it. I'm looking over here. I'm trying to figure out, is this a good investment for the next 3 or 4 years? What it does over the next 3, 4, 6, 12 months is irrelevant to me, okay? A bear case for Meta would probably be something like 10% revenue growth. This would be, 190%. That'd be nice. This would be pretty disastrous for Meta to only grow 10% a year over the next number of years, and maybe 12% net income growth. So just barely outstripping there. And we can say like a 22 PE on the low end to maybe 27 on the high end would be pretty fair for a company grown barely double digits like Meta. And so even under a bear case, I still get between a 7% CAGR and about a 12% CAGR here. So once again, there's a reason Meta's the biggest position for me in the public count. Like the stock's it's still a buy. Like that's the thing about Meta. Like it's still a buy even here, right? Now, what about these stocks like Chipotle, Cava, Sweetgreen? Okay, so let's go ahead. Let's on 1000X here pull up the compare feature. One of my favorite features on 1000X, right? Like where are you going to get the ability to compare 3 companies, all these metrics that are relevant to you, all in one place? Dude, every single person watching us, you should have access to 1000X. Like if you don't have access to 1000X, like I don't know what to tell you, man. Like bad financial decision. Like everybody should have access to this. Okay, Sweetgreen, and then we're doing Cava. This is like, where else are you going to be able to do this at, man? It's insane. So what we're going to find here with these, right, is they're all valued very differently. So Sweetgreen's unprofitable, right? So we're not even getting PEs on Sweetgreen. Chipotle's at about a 32 forward PE, 27 2-year forward PE. Cava trades really rich, but keep in mind Cava's much higher growth than somebody like a Chipotle, right? Chipotle's current year expected revenue growth is around 7% here based upon analyst estimates. Cava's expected to be like 27%. And you look at next year's revenue growth, Chipotle's supposedly supposed to get back up to 13%. Analysts might be too bullish on Chipotle, by the way. Cava's supposed to do about 19%, right? And Cava obviously has a much bigger opportunity to expand a lot of locations. Like Cava has a very small amount of locations compared to something like a Chipotle. So, if I look at this, the issue with all these companies is Sweetgreen's a money loser. So you're like, I don't know if I'm going to touch a money losing company like a Sweetgreen, right? Chipotle still trades rather rich if you feel like these growth rates are unrealistic. And if you feel like Chipotle is just going to be a single digit grower from here, then you can make an argument that Chipotle is a little rich here. It's not super overvalued. It's just maybe a little rich if you think it's a single digit grower. Now, if they get back to double digit revenue growth, that's a whole different story then. Because then if Chipotle was able to get back to double digit growth, right, in revenue, and then they continue that for the next several years, I can make a strong argument that Chipotle's undervalued here. But that's a debate if they're going to be able to get back to double-digit growth. Cava, I ran projections on Cava here. So let's go back to intermediate projections. So we have the ability to essentially save your files now, which is very nice. So if I recall, I saved Cava here. So let's load data for Cava. Hey, that rhymes, huh? Data for Cava. So here's my Cava bull case, base case, bear case. Under the bull case, I had them doing 25% revenue growth per year, 2026 to 2029 on average, net income growth of 40%, so at a much faster clip. Puts them at net income margins in the 8s, which isn't a crazy number for Cava over time. Like they should Cava should get to 10% plus net income margins in the 2030s, right? So I don't think somewhere in the 8s is crazy come 2029. That would actually give you an amazing CAGR on this one, 24% on the low end, 32% on the high end, right? But I have it on a 70 to 90 PE ratio because they would have such big growth rates that they would be able to command a big valuation on it, and people would still look at it as there's still a massive opportunity to open so many more restaurants after 2029. Now, my base case has 20% revenue growth, 35% net income growth, 60 to 80 PE ratio, which if they're growing 20% top line, 35% bottom line, and then people still think there's another 1,000 or 2,000 restaurants to open, like a 60 to 80 PE is not crazy at all. That gives you a CAGR of 15% low end, 24% high end, which isn't bad. That's pretty dang impressive. Now, my bear case, a little, troubling. This would be 15% revenue growth top line, 20% net income growth bottom line, 40 to 60 P, which, you could say still very high based upon the market, but not crazy based upon those sorts of growth rates. But there, you'd have trouble making money in the stock over the next few years. So if that bear case comes true, Cav is very dangerous. You could be stuck in the stock and make no money for the next years, right? All the way through 2029, that'd be brutal. So, if Cava keeps falling, maybe I step in, but we'll see. We'll see. There's a lot of opportunities in the market, and cake's one of the best opportunities. I haven't saved up my cake projections yet. Maybe I'll share those with you guys in the future, okay? Oh, it is so hungry, that public account. It wants $4 million so bad. It's getting there. It's getting there. Slowly but surely, baby. We're going to hit $4 million in that public account. So I'm recording this the second week of September. I have an incredible video for you guys here today. Whenever I get into the September, October timeframe, I'm already thinking about the next year. So I'm already thinking about 2026, how the market's going to transform next year, what the best opportunities are, hedges I need to make my portfolio, things like that. So I thought, since I'm already kind of thinking about 2026, let me do a video here today about 7 stocks that are a must buy before we get to 2026, okay? So that's what we're gonna get into here today and why these are incredible opportunities. I'm gonna share price targets with you, the bullish case, the bearish case, all that good stuff, okay? I hope you guys appreciate me sharing all this stuff with you guys. This was a beast of a video for me to put together here for today. Like, oh my gosh, okay? Listen, for everybody that's already smashed the like button, I appreciate you guys so much. Thank you for that. If there's anybody watching this that has not hit the like button on this video yet, please do that for me. That's all I ask in return for this beast of a video. This took hours and hours. I've been prepping this video for shortly after I woke up, I've been prepping this video, okay? Now I'm finally recording it for you guys. I hope you appreciate it. I appreciate you. All I need you to hit that like button, okay? Additionally, if you want to be subscribed to the channel, you can certainly subscribe. We're well over 880,000 subscribers. Appreciate each and every one of you for being here. If you need access to all my premium courses, access to my private Discord chat, exclusive weekly videos, 1000xstocks.com, all that stuff, that will be the pinned comment down there. You can click on that, fill out a form. Let's see if we can get you access in there. Additionally, in the description area down there, if you want to follow me on X, if you use X, or if you want to follow me on Instagram, those are always linked in the description area of my videos, okay? Alrighty, now that we took care of business, let's get into this. The first stock of these 7 stocks up here that is a must buy before we get to 2026 is Celsius Holdings. Ticker symbol on this one is CELH. This is an energy drink company. It is a $55 stock as of right now. Now I'm doing tremendous on this position. Average cost in the public count is $24.39. We're already at $124,000 on the stock. It's been a tremendous performer for us. It's got a long way to go in regards to this. Whenever you see, a stock that has been performing great, sometimes people think like, oh, it can't do any better. Listen, man, like Celsius used to be a $5 stock, and that had been a big jump for it. Celsius used to be a $20 stock, and that was a big jump, right? Now it's a $55 stock. So, if Celsius goes where I think it's going, like we have a long, long way of upside from here. Now, you gotta understand, this stock is actually still trading at a monumental discount from where the stock was trading at just last year. At its 2024 highs, this stock got close to $100 a share. Today it's 55. Now, I can make a very strong case for you that this company actually should be valued more where it used to be valued back then, because now we got rid of the bearish narratives around the stock and we have a whole lot of bullish catalysts going for us in the future here, okay? So, first off, we're already basically PepsiCo made an investment in Celsius a few years ago. Then Celsius had these skyrocketing numbers because PepsiCo basically had distribution all over the place. Well, what happened was then PepsiCo had a little over ordering, and then additionally, like Celsius had these ridiculous comps because PepsiCo basically got Celsius into just about every single store you could possibly want to be in the United States of America, right? PepsiCo has incredible reach, incredible distribution. So what happened is Celsius showed really kind of lame numbers when it comes to revenue for really like the past year, and it was because of that. Essentially, you come off those brutal comps and over ordering, it's a double whammy. No, that's over. That's no longer an issue moving forward, which is phenomenal news for 2026 numbers for Celsius and moving forward after that. Additionally, Celsius now owns Alani Beverage. This is a company they bought very recently here. They just, acquired them like literally in the past few months. They now have them integrated into the company. Now, Alani, some of you guys might know this, it's been an energy drink brand that has been really, really popping off in, just across the United States of America recently. And so I'm sure a lot of folks know of this brand. Additionally, they just acquired Rockstar Energy. Now, Rockstar Energy, smaller player. From what I understand, it's about a 2% player in the United States of America. Used to actually be really popular, but what happened was PepsiCo bought out Rockstar basically at the beginning of 2020. And PepsiCo paid almost $4 billion for Rockstar. Now, Celsius is getting Rockstar for basically pennies on the dollar. This is like, they almost got to gift it to them. It's ridiculous. Like, they paid hardly, it's insane. Like, the deal that Celsius just did for to get Rockstar brand is unbelievable. And so hopefully Celsius can revive Rockstar. If they can't, it's not a game breaker, for Celsius in any way. It's just only upside, in regards to this Rockstar brand and what Celsius might be able to bring them back to. But basically, these PepsiCo, Coca-Cola, they've tried a lot of energy drink brands over time. They bought different energy drink brands and they all crashed and failed. Every single one of them. And so Coca-Cola realized, let's just make an investment in somebody. So what Coca-Cola did years ago, a lot of years ago, is they invested in Monster Energy. They own around 20%-ish of Monster. And PepsiCo realized, dude, we're a failure at this. Let's just acquire a part of Celsius. And so PepsiCo's now a big shareholder of Celsius, essentially, okay? Now, additionally, this was something that's massive, and I don't think people understand the ramifications of what this means for growth rates for Celsius moving forward in 2026 specifically. So listen. In that deal, basically, PepsiCo announced that they're now going to distribute Alani. Now, remember what happened with Celsius's numbers when PepsiCo did the distribution deal with them. They went through the roof. So what do you think is going to happen with the Alani numbers in 2026 as PepsiCo distributes those products all over the United States of America? My guess is, remember, Alani's already got incredible growth even without this PepsiCo deal. So now this is like putting a rocket booster behind Alani now at this point in time, right? So what you're going to see is Alani's growth rates skyrocket, Celsius's growth rate skyrocket simultaneously. This is a big, big deal, and that's in the United States and Canada. Now, additionally, if you look at how Alani was distributed prior, it looks like they were basically through a beer network, which is okay, but it's not ideal. It's not ideal, okay? And as somebody that used to work, for Walgreens back in the day and dealt with distribution companies, and as somebody that used to be a manager at QT, Quick Trip back in the day, you really want to have your distribution with Coca-Cola or Pepsi, okay? Just trust me. It's a much better situation, okay? Now, here's the revenue of Celsius, and this is what has transpired over time. Now, this was that come down of the Pepsi over ordering and the distribution, the tough comps and all that stuff, right? Okay, it was so depressing for like a few quarters there. This is where we're back to now at this point in time. And what you're going to see is revenue skyrocket for this company for quite a while. Now, in regards to the energy drink space, is a 3-horse race now at this point in time, a 3-horse race between Red Bull, Monster, and Celsius. Now, if you add up to the Celsius market share with Alani, with Rockstar, you're at roughly around a 20% market share or so. And long-term, Celsius might be able to get this to like 25% or somewhere like that. Maybe best case scenario, like 30% market share, which would be incredible if they had that in North America, that sort of market share, right? Now, the thing you gotta understand is Red Bull and Monster, right? I just thought Red Bull, it gives you wings. Here's the deal. And this is a problem for Red Bull and Monster actually have some pretty big problems going for them, okay? So toward the end of 2022, the co-founder of Red Bull, passed away. All right. Now, in his place, they decided to do this weird thing where basically they're going to have 3 CEOs that are kind of on the board of directors to make big decisions, which is I don't know about this. I don't know about this, guys. That doesn't sound like it's going to be good long term. And so Red Bull, I would say, doesn't have the best leadership situation going for them anytime soon. Okay, and I think long term that's going to end up hurting Red Bull significantly, and Celsius has a lot to gain there. Now, additionally, in regards to Monster, there's basically co-CEOs that built this. Basically they acquired this company back in the 90s. And then they started the Monster Energy brand around 2002, and they made it double the size of a Red Bull. And the brand took off, to unbelievable heights. And 2 gentlemen led the company throughout this whole time, Rodney Sachs and Hilton. Well, basically, Rodney Sachs is stepping down from the company, but he is still going to be the chairman of the company. So these guys are kind of at the end of their run in regards to the Monster run, which is a historic beverage run they've been on, right? Now, Hilton's going to continue to run this company, but he's way out of his working prime now at this point in time. He's about 73 years old, from what we understand. Now, keep in mind, your prime as far as a CEO is about 45 to 65. That's the time period when you still have a lot of energy, right? You have experienced a lot in business. You know how to navigate, different situations. You understand this game on a high level. And so Hilton's now well out of his prime. I don't know how much longer he's even going to run Monster. And so somebody's going to have to take it over. Maybe Monster ends up getting sold to Coca-Cola over time. I don't know how they're going to end up. But the moral of the story is here, like the guys that built Red Bull, the guys that built Monster, they're already left or they're on their way out, essentially, right? Meanwhile, John, who's led Celsius over the past number of years, he's built this company into what they've become, right? And he's in the prime of his working career. If I recall, he's 44, 45 years old, just right entering the prime of his career. And so we've got Red Bull and Monster who are going to be, in my opinion, on their back foot for the next 10 plus years. And we've got Celsius with a CEO that's going to be in his prime for the next 10 years. And so I think that is not the best thing if you're Red Bull or Monster, but I think this is very good news for Celsius at this point in time, because remember, Celsius needs to just keep grabbing market share. Now, when it comes to Celsius, here's the deal. Okay, listen. The whole market cap of the company is around $14 billion, all right? Which is a decent sized drink company. Looks like it's around the 28th biggest market cap company. But where they're trying to get to is like a Monster type company. Monster's over a $60 billion market cap. Now keep in mind, Celsius and Alani, they have so much more of an opportunity. Like the rest of the 2020s is really just around getting those 2 brands around every place you can possibly imagine in North America, right? And then reviving the Rockstar brand. 2030 and past is going to be the international game. Just like for Monster, really, a lot of their success over the last 10 years has come from international, right? They have a great core, North American business, but then international's kind of been a great boost to Monster. And so Celsius still has that whole game to play out, folks. So it's going to be a fun next 5-10 years in regards to Celsius. So Celsius, I remain very, very bullish on this company. I think it's still very early days in the build out. I like the way everything's lining up here. I love John, the gentleman that's been leading this company for the last number of years. He's done an amazing job building this from just a joke little micro cap company into a serious contender in the drink space, right? We're going to be talking likely someday about this being a top 10 biggest market cap company when it comes to drink space. At least that's in my opinion, right? Because a lot of these other companies are dead for growth. They're dead for growth, right? Alrighty, guys. Number 2 of these 7 stocks up here is, and there's a lot of similarities between this company I just went through and this next company. You know what it is? Elf Beauty. Ticker symbol on this one is ELF. $138 stock here today. Now, this is a stock, it's performed unbelievable for me, up almost 1,800% in the public count. Cost base on this one, $728. Those were shares I acquired back in 2019. Now, you might just think I'm just sitting on these shares that I've had for 100 years now. No. I've been buying the stock heavily this year across different portfolios. This is one of my bigger positions. I'll show you guys here. For example, this is 1,500 shares. My average price on this one is $59.13. So I've been buying ELF heavily this year. We're already up $118,000 on this. So it really shows my conviction of ELF from back in the day and ELF in current day, like as in 2025, right? Now, here's the deal. Okay, this is what I'm showing you right now is 1000xstocks.com. This is my premium software I use on a day in, day out basis, okay? And this is our charts feature. So we have a ton of different charts on there that can really give you an understanding of where the company's been, where the company's likely going, right? Now we can see when it comes to Celsius's earnings per share, it skyrocketed, and then we went through kind of a nasty down cycle, right? As the company just kind of focused on growth, acquisitions, with road acquisition, which we'll get into in just a moment, all these sorts of things, right? So we're right here. This is where we're at right here. This is where the company's earnings per share is expected to go based upon analyst expectations here, right? We're about to get into an unbelievable revenue cycle that we'll speak more about in just a moment. But additionally, over this next 1 to 2 years, you're going to see the earnings per share of this company skyrocket as well, which is going to be a whole lot of fun. Now, here's a free cash flow of the company recently. Here's a trailing 12-month operating cash flow of the company. Imagine where free cash flow and operating cash flow are 2 years, 3 years out for this company. I mean, the numbers are going to be shocking in regards to this, right? Now, ELF Beauty, the cosmetics company, also has shareholder equity that has been skyrocketing over the years. Phenomenal. Additionally, what I'm showing you now is trailing 12-month revenue of ELF over time, right? It's a growth company. It's a major growth company. And they're about to put it with a turbo booster behind it. You know why? Because they acquired a company named Rhode Beauty. Rhode Beauty, which is a company started by Hailey Bieber. This company just got into Sephora. Now, Sephora, if you didn't know, Sephora is owned by Louis Vuitton, and it's a very popular cosmetic store. Rhode Beauty, for the most part, has only been a brand that really sold like direct to consumer. So the fact that now they're going to scale this out into retail is going to be monumental for them. And I think it's genius that they're going into Sephora. And the reason being is this brand they don't want to be like super high end. They don't want to be like Estee Lauder. At least it doesn't come across that. They don't want to be an Estee Lauder or those sorts of price points, right? And super niche like a Louis Vuitton, because Louis Vuitton sells some makeup and beauty products as well. But they're not trying to go there. But they want to be like a higher end than, let's say, an ELF, which is a great opportunity for them, right? Now you go to their website, like they understand like marketing to the newer generation, whether it be even the millennials, but especially like Gen Z, Gen Alpha, like they just get it. Like you just go to their website and you're like, they get it, man. They understand like what's cool, what's not cool, and all those sorts of things, which is big for them. Now, I was looking at some of their products they were highlighting on their page. It's a different price point than what ELF is used to. Like they got this peptide lip trio. Maybe I should use that. Three little tubes here, and it's $56. So that's different price points. Like ELF, a lot of ELF products are like, a lot of $10 and under products for ELF, right? Especially 15 and under. This, you get like this duo here of blush and lip combo, which is $45. So they're at a higher price point than ELF, which could actually help ASP's average selling price for ELF as a whole company in a monumental way. Now, this company is very successful on social media, which shouldn't come as a surprise with Hailey Bieber. And, obviously she's married to Justin Bieber and, networked with all the celebrities you want to be. They all those folks really understand social media on a very high level, right? And so they have 3.7 million followers on Instagram, for instance. ELF has 7.5 million. So considering how small Rhode is, that's amazing. And ELF understands, I think, social media better than probably any makeup brand out there in the world. It's incredible, right? Now, the bottom line is with ELF, growth is back. Baby, growth is back for ELF. And this is huge because you understand everybody and their grandma wants to be an ELF when they have the big growth numbers. And they're about to have the big growth numbers again. And so I think you're seeing a pile in regards to the stock. I mean, this stock was $49 just back in April. And it's already at 133. I don't think this pile up into the stock is going to end anytime soon. It won't end, in my opinion, until we see a peak in revenue growth. And I don't know when that peak in revenue growth is. My guess is it's probably 1 to 2 years away. 1 to 2 years we'll probably see. And when I say peak in revenue growth, I don't mean like, the company never grows after that. What I'm talking about is the revenue growth acceleration. Because what you're going to see is a massive acceleration cycle now for ELF and Rhode. So my guess is we probably see a peak at that at some point in the next 1 to 2 years. But between now and then, the stock's just going to continue to beast. People are going to be like, oh my gosh, they got the growth again. Like, you got to be in it. Because where else are you going to get that? In the makeup and beauty industry. If you want to invest in any sort of cosmetics related company, where are you going to get big growth? You got one option. It's e.l.f. That's your only option. Like, look at all the other cosmetics companies and look at there's no other option for you. There's one option, which means there's a pile in of the stock going to be for quite a while. And so the other thing with e.l.f., right, is this stock still trading at a big discount to where it was back in 24. I mean, this stock peaked well over $210 back in 24. It's $138 today. And so you're going to likely continue to see a pile up, and don't be surprised at all if this stock is $200 plus before you know it. So something to keep in mind there. e.l.f. has a beautiful next 5-10 years ahead of that company. But, you know, in terms of even the short term, as in the next 1 to 2 years, oh my gosh, phenomenal. Okay. Alrighty, guys, next up here, number 3 of these 7 stocks is Google McDougal. $234 stock here today. It is easy money. It's been easy money. This stock I bought in the public count back April 23rd, 2025, already up almost 50% on that position. Easy money. Google is easy money. I've been saying it for a while. It remains easy money, right? Look at Google. I mean, it's incredible. 3 billion users on Android, 3.3 billion on Chrome, 1.8 billion on Gmail, Google Drive 1 billion, Maps 1 billion, Photos 1 billion, Play Store 2.5 billion, Search 3.6 billion, YouTube has 2 billion plus users. I'm surprised it doesn't have over 3 billion users when it comes to YouTube, by the way. It's a deep company. It's a very deep company, and one of the leading companies, in my opinion, in the artificial intelligence space as well. And this is a type of company, like, it's safe. Like you think about like how diversified the business model is. It's a pretty dang safe business model, especially now that the government's not going to tear them apart. There was worries that, the government might tear them apart. That's out the window now at this point in time. Look at the income statement of this company. Does this look like a company is doomed and they're screwed? I don't think so. $96 billion. This is their latest quarter they just reported. $96 billion plus of revenue versus $84 billion in the same quarter last year. If we look at income from operations, it went to over $31 billion from 27.4 in the same quarter last year. Net income $28 billion from $23 billion in the same quarter last year. Grade A income statement for Google McDougal. By the way, if you don't understand how to grade income statements, balance sheets, cash flows, that's like very core to what you need to understand the market. Check out my private group. Well, I got the course curriculums. I can teach you how to do all this stuff, so you're not lost. Because if you don't know how to grade an income statement or a balance sheet or cash flow, that's a good luck. Good luck in the market long term, right? Now, this is our charts feature here on 1000xstocks.com. Look at that perfection. That is what you want to see. When you pull up a trailing 12-month chart of a revenue of a company, that's the beauty you want to see right there. I mean, it's just perfection. This is where we're at right now. This is where we're expected to go. It doesn't get better than that, man. When you just want up and to the right, and that's exactly what Google gives you, up and to the right. Additionally, obviously, the margins are great for Google. That shouldn't come as a surprise to anybody. Look at the earnings per share. This is where we're at right now. This is where we're at, right? Look at the trend. Look at where we're expected to go. I mean, is beautiful, okay? Look at the operating income of Google McDougal and where this is trending. This is where we're at right now on a trailing 12-month basis. Lovely. Top 5 balance sheet in the world. Look at the shareholder equity. Just continues to boom for the company. I mean, when you talk about a really safe company, you got to have a company that, can't just be disrupted easily. And you got to have a company that has an amazing balance sheet and a strong moat around the business. And gosh, that is Google McDougal, right? Now, additionally, shares outstanding. This is one of the most, I think, overlooked things when it comes to Google. You've got a lot of things to be bullish on with Google, but I think this is so overlooked, and I think investors really need to start paying attention to this. Shares outstanding has been going down, 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 down for the company. Listen, what happens with Google's profits? What do we see with Google's profits? They continue to go up significantly. What do you think they're going to continue to do with those profits? They'll obviously spend on the AI future and other options. We know that. They have a small dividend. They might up that time. We know that. Okay, what do you do with the rest of the money? Because there's so much money pouring into Google. Like this company, just in its latest quarter, which that wasn't even that wasn't even the best quarter for them. Like best quarters are always, that Christmas quarter because of the advertising side of the business. So they just did $31 billion in net income in a 3-month span. They're doing over $10 billion a quarter in net income. They have so much money, they don't even know what to do with it. So you know what you don't know? When you don't know what to do with it, you know what you do with it? You do share buybacks, which helps earnings per share immensely because the company's net income just keeps going up and up and up. Then you keep bringing shares down, earnings per share skyrockets. And that's why Google can honestly get a 20%-ish EPS growth for a long, long time to go in the future, right? Now, let me take you into my projections on where Google stock is headed from here. I'm going to take you into my bull case, base case, and bear case for this company, okay? On 1000xstocks.com, we have a projections feature. This is one of the most important things you can ever do with the company. If you are not using projections when you're running your company's numbers, you're not playing this game right. You have to run projections for where you see a company's revenue going, net income going, and where you think fair P ratios are. You have to do this, guys, okay? If you don't have access to 1000xstocks.com, build your own spreadsheet out. It's going to be a pain in the butt because we automatically populate what the numbers are expected for this year and all those sorts of things, and the calculations are already done for you. So this will save you a ton of time, and it saves me so much time. But back in the day, before 1000xstocks.com existed, I used to have a spreadsheet, and I'd run my numbers that way. You've got to be able to do this, guys, or you're going to end up in a lot of problems in the stock market, okay? But basically, we just launched this new feature a couple weeks ago where you can actually save company projections. So I have a few companies saved at my Adobe projections, Amazon, Apple, so far, Duolingo, Google, LVMH, Palantir, Salesforce, and I believe I just saved up AMD as well. So I go ahead and click on my Google. That pulls up my projections from a couple weeks ago I did on Google. So my bull case for Google, I had them doing 12% revenue growth on average per year, 2026 to 2029. Does that sound crazy? I don't think so. I've been doing 15% net income growth. Does that sound crazy? I don't think so. No. P ratio. A 12% grower on top line, 15% on bottom line, 25 to 30 P is pretty fair, right? So in that situation, Google stock should be somewhere between about $443. This is in 2029. Somewhere between $443 and $532. Give me a compound annual growth rate. We can call it somewhere around 20% in the bull case. Not bad, especially for a company as safe as Google, right? Incredible. Base case. So base case is just a fancy way of saying this is what I expect. Now, I'm always a little conservative in regards to my base case, but this is what I expect for Google over the next number of years, okay? Now, revenue growth, 10% per year on average for those years, and then doing 12% on average net income growth. A 23 to 28 P is pretty fair for this company. That gives me a compound annual growth rate on the low end of 12%, on the high end 18%. That's a pretty good return on my money. I will take that, especially for a safe company like Google. My bear case for Google, this would be a disaster. This would mean they really actually got disrupted by AI. Only 7% revenue growth. Oh my gosh. Only 8% net income growth and a 2025 P. Guess what happens? I still make money. A disaster for Google comes. And guess what happens? I still make money. I would still get a compound annual growth rate on the low end of about 4%, on the high end 10%. Give me Google stock. Give me Google stock. And this is why you've seen me continuously buy Google stock almost nonstop in the Patreon portfolio recently. Because I'm like, if I can run a bear case and still get a very positive outcome, thank you. I'll gladly take that every single time, okay? So, Google McDougal is number 3 of 7. Number 4 of these 7 stocks up here is, that you got to buy before 2026, is ADBE, Adobe. I got a relatively new position in Adobe in the public count. I got 330 shares. So far, I'm up $2,000. It's basically this is roughly flat. Okay, I'm up 2%. That's like nothing, right? Now, if I recall, Adobe was one of the stocks I spoke about in 4 stocks I'm buying September 2025 edition. I believe it was either one of the stocks featured or was an honorable mention in that particular video. And I've been talking about Adobe quite a bit recently on the channel, right? Now, when it comes to Adobe, here's kind of my different cases for Adobe. Here's my bull case. My bull case, listen to this, guys. My bull case, my bull case has them only doing 10% revenue growth per year, 2026 through 2029. 10% revenue growth. That's my bull case. I've been doing 12% net income growth, only 12% per year, and that's my bull case? No, for a SaaS-ish related company that has recurring revenue streams, 25 to 30 P is pretty fair. In that bullish scenario, it gives me a compound annual growth rate of 20% on the low end and 25% on the high end. My base case for Adobe, what a depressing base case. What a depressing base case I have. 8% revenue growth on average per year, 2026 to 2029. 10% net income growth on average per year, right? 23 to 28 P ratio. Such a depressing bear case. Base case, excuse me. This isn't bear case, this is base case. And I still get a compounding annual growth rate of 15% on the low end, 21% on the high end, with 8% revenue growth per year. Free money. It's free money. Come on, man. Now, here's my bear case for Adobe. Bear case for Adobe would be 2% revenue growth, 2% net income growth. That's so ridiculously bearish, I don't even know what to say. 15 P ratio, basically the stock would give me a negative return, right? But that's just like ridiculous. Like, okay, Adobe's gonna grow only 2% on the top line, bottom line. The moral of the story is here, in regards to Adobe, like, yeah, it's not the most exciting stock in the world, but if I'm going to run a boring, sleepy, put me to sleep base case like this, and I can still get a compound annual growth rate of 15% to 21%, dude, I got to take the money. It's free money. Like, okay, give me the free money. It's a money tree. Like, come on, man. Like, and we are not even accounting for all the shares they're going to buy back over the next number of years. It could give a compound annual growth rate of 20% plus. Keep that in mind. Stock number 5 of these 7 stocks up here. Oh, is this one hated? Ooh, it's a hated stock. But my gosh, the return is going to be beautiful. And you know what it is? Nike. N-K-E. Nike. So this is one I now own 2,777 shares. Me and Phil Knight, we pretty much control the company at this point in time, okay? And this is just in the public account alone. I've been buying this stock in other portfolios. I'm down 4% on it. I think I'm going to make a lot of money in Nike over the coming years. And I think this is a stock I can hold for years, if not decades, to go in the future. You know, I was watching some football this weekend, like I'm sure a lot of people are watching football, right? Nike commercial came on, got chills from that baby. It's not the first time. I'm just like, man, woo! They know how to, they understand marketing, advertising, branding at a higher level than any other company in history. It's unbelievable what they're able to pull off. I mean, I watch other shoe companies' commercials and it put me to sleep, and then a Nike commercial comes on and you just get chills. It's unbelievable what this company does. No, I spoke about Nike quite a bit on the channel recently, but I recorded a video for my private stock group members, was that a couple days ago or so, right? And I said, what can we learn from Buffett and his biggest stocks? And basically what I did in that video for the private stock group members, I looked over Warren Buffett's biggest positions. And then I said, what can we derive from like Buffett's magic in regards to how he's been able to grow wealth over time, right? And we came up with basically what I was able to come up with is when it comes down to his biggest positions, he really makes sure they have incredible moats around them. And they're near impossible to really penetrate. And like the companies are almost have like a monopoly type competitive positioning that you just can't end up competing with them. And what you realize when you go down the Nike rabbit hole is Nike has no competition. Now, if you haven't gone down the rabbit hole, that sounds ridiculous. Like, what? Nike has no competition? I mean, there's Adidas, there's Hoka, and there's On, and there's what are the other brands that are hot at the moment, right? I think Lululemon sells shoes right now. I don't know how hot they are. I mean, there's so many companies who say, oh, what the heck? How does Nike have no competition? Everybody sells shoes, right? Plenty of companies sell athletic clothes. I can tell you, Nike has no competition. They have no competition. The reason they have no competition is because no one can invest in the brand the way Nike does. What happens is they go through, other brands come out, they go through a hot spell, they decide to reap maximum profits from that, they don't invest in their brand, and they falter. I can take you through the 1980s, the 1990s, the 2000s, the 2010s, and now I can take you through the next generation. It never fails. It never fails. These companies will they're a Nike competitor and they're hot for a few years. They make maximum margin on that. They don't invest in their brand and they falter every time. The closest thing I saw to a real competitor to Nike, the closest thing was Under Armour back in the day. Under Armour was the closest thing. Kevin Plank, he really was investing in his brand at Under Armour quite a bit. And he really spent on it. And that was the closest thing I've ever seen to Nike. And you know what happened to them? They failed. I think Under Armour stock today is like a $5 stock or $7. They're like they've been in a gulag on and off. Like it's just they exist. They're still a company, but it's just like, they never became Nike. No one ever becomes Nike. But they were the closest thing. In the last 40 plus years, Under Armour was the closest thing to actually pulling it off. And they still couldn't do it. And so you just got to understand there's no actual competition for Nike. There's only two ways Nike can be hurt, essentially. One is the consumer. When the consumer's in a bad spot, they've been sliced and diced by inflation. That means they have less money to go spend on a new pair of Jordans or, a new pair of shorts or whatever it is, right? A new shirt. So no doubt when the consumer's hurt, Nike can get hurt because Nike sells to everybody. It doesn't matter if you're rich, you're poor, you're middle class, Nike sells to you. The only other thing that can really hurt Nike is themselves. And that's exactly, basically what happened was a guy that was from consulting world. They brought him in to run the company over Elliott Hill. Elliott Hill decided to leave the company. It was a huge mistake. He made a ton of bad moves for Nike. He screwed up. And now Elliott Hill got brought back in last year and he's running the show again and he's doing it on a very high level and he's bringing Nike back to its glory days. And you'll see that continue to play out over the next several years. And so, you got to understand they had basically a double combo. That's why Nike stock is so discounted right now. The consumer got sliced and diced by inflation and they hurt themselves because that consulting CEO screwed up in so many ways. And, but it's all a thing of the past now. It's all a thing of the past, right? The super high inflation, it's a thing of the past now. That consulting CEO, was it named John Donahoe or whatever his name is, joke. Made so many bad decisions, are ridiculous, and that's a thing of the past. And so, you just got to understand that. Now, here's the deal with Nike. If you're not buying it right now during a time like this, you will never own Nike. You'll never own the stock. Because this rarely ever happens that you get the stock trading at multi-year discounts like this. This is the time to be buying a stock like Nike. If you believe in Nike over the next 10, 20 years, you gotta buy during a time period like this. If you don't buy now, you will never buy this stock. You gotta understand, this company only goes through bad times every so often. So back in 1983, the stock fell 34%. 1984, the stock fell 47%. Massive crash in Nike stock. Imagine if you bought back then, you would be a billionaire probably, or just ridiculously rich. Okay, let's just call it that. You're rich enough to have your own yacht. Let's just call it that. Okay. 1986, the stock fell 14.5%. 1993, the stock got absolutely decimated. Lost nearly half of its value that particular year in 1993. 1997, the stock got hammered 34%. In looks like 2002, stock fell 21.5%. 2005, the stock fell 3.6%. 2008, the stock fell over 18%. By the way, this wasn't even to the lows. This is just where the stock started the year versus finished the year. So keep in mind, these numbers were all much worse if you look at intra-year. 16% fall for the stock in 2016. You can take advantage of a time period like this with a stock like Nike, add to that stock, throw it in the filing cabinet, hold it for the next 10, 20 years, or you don't. It's one you either get or you don't get. And I think I get it. And I think we're going to make a whole lot of money in the stock over the next number of years. And then it's going to be such an easy stock for me to hold. As long as whenever Elliott Hill is done with the run he's going to go on, my guess is Elliott Hill will probably run this company for the next 3 to 7 years. Whoever he hands it off to, it just needs to be somebody that's from Nike's culture and understands the company on a high level. They cannot bring in some consulting guy again whenever that time comes. But that's still several years away. My guess is Elliott Hill really wants to make sure this ship is all in the right direction. Revenues, margins, EPS is going up year after year after year before he says peace out once and for all and goes into true retirement. Okay. Stock number 5 of these 7 stocks is number 6 of 7. Sorry, 6 of 7 is CRM, Salesforce, $252 stock. here today. So Salesforce, this is a new position for me in the public count. So far, I'm up about 3.7% on it. 243 is my cost base on this, relatively new. I just started adding this one September 4th, 2025. The thing with Salesforce is this stock's been dead for 5 years. Dead for 5 years. Now, there's two reasons the stock's been dead money for 5 years. One is it was overvalued. Two, people have given up on Salesforce. Now, when you look at the numbers, you say, what are they giving up on? These numbers look great. But it's what has happened, essentially, okay? Now, I posted this inside the private stock group, okay? Basically, Salesforce, keep in mind, Salesforce is going to do well over $40 billion of revenue this year, okay? Well over $40 billion. They have this data cloud and artificial intelligence side of their business, which is growing rapidly, 120% growth on a year-over-year basis, right? They're up to doing over $1.2 billion on basically annual recurring revenue. But it's a really small absolute number when you compare it to a business that's going to do, probably between $41 and $42 billion. So although this side of the business is growing rapidly, in Agentforce, which they just launched in the past year, essentially, Agentforce has been taking off, and this is an incredible opportunity. It's definitely worth diving into and getting educated on what they're up to with Agentforce and why it matters for mid-sized and large companies, essentially, right? But this business is growing rapidly, and so you got to understand this company is really going to start to be very positively affected by all this growth here in 27 and 28, because that's when these numbers are going to be huge on an absolute basis. And that's when it's really going to start to increase the revenue growth rapidly with this company. Now, additionally, they should have the Informatica deal that should go through. It's about an $8 billion acquisition. That deal should go through in 2026. So the revenue is already going to get boosted up significantly in 2026, slightly because of this, even though it's still going to be a small absolute number, but really because of that Informatica deal. And then obviously there's a revenue growth that goes on at Salesforce in general, right? So the growth rates for Salesforce, I think in 26 are going to be an acceleration over 25, right? Then we're going to see another acceleration in 27. I think we'll see another acceleration in 2028. The one wild card is if we have some monumental recession in the next, 2 or 3 years, that could throw things off. But that could be said for any company. But as long as the economy is okay or good, you're going to see revenue growth acceleration in 26, revenue growth acceleration again in 27, and then revenue growth acceleration again, in my opinion, in 28, which is going to be very exciting times for Salesforce, okay? No, I don't think my bullish case for Salesforce is bullish enough. I think I got to up these numbers. I think I'm going to redo my projections tonight, because I think my bull case should be even more bull than this. I've been doing 12% revenue growth on average per year, 2026 to 2029. Now, remember, the Informatica deal should go through next year. That's going to be a huge boost to revenue. Then they're going to likely integrate that, start selling that even more rapidly, right? Probably go up on pricing. And then the absolute numbers on their AI side of the business and data cloud is going to really start to matter as the years go on. So I think 12% revenue growth is too low for a bull case on Salesforce. I'm going to probably bump it up to 14 or 15%. So just understand what you're seeing right now is actually not bullish enough. Net income growth, I think 20% is very fair for Salesforce going in future years. 27 to 32 PE ratio, so that gives me a compound annual growth rate on the low end about 16%, high end about 21%. My base case, I also want to take my base case revenue up to probably where my bull case was at. But this is my previous base case, 10% revenue growth per year, 26 through 29, 18% net income growth, right? 25 to 30 PE. That gives me a compound annual growth rate of 12% low end, 17% on the high end. And then my bear case has 6% revenue growth on average. Complete dumpster fire disaster for Salesforce. This is like they got disrupted by AI or something. 10% net income growth. That gives me compound annual growth rate of 1% on the low end and 6% on the high end, right? For Salesforce. Now, additionally, you got to always think about who's the big dog leading the company. We spoke about some of them already in this video. You got Benioff leading this company. The man is an absolute goat salesman. An absolute goat salesman. He is incredible. The job he has done leading this company over time, just a 101. He grew Salesforce from nothing into, I would say arguably or probably definitely the most important SaaS company in the world, the most important, customer relationship management company in the world. It's incredible what he's done. And so, you just don't bet against Benioff. Don't bet against Benioff. Anybody that's done that, I mean, the man's got stories on stories he can tell you about, back when he was friends with Steve Jobs and he worked for Steve Jobs. He can tell you stories about when he worked for Larry Ellison and advice he got back in the day. And he's full of all types of great stories as well. No, I am a Palantir shareholder. I've been able to take ridiculous profits in Palantir this year, right? Incredible gains. And I'm still sitting on incredible gains, but I only own 1,000 shares. And the reason being is Palantir should not be valued more than Salesforce. It shouldn't even be remotely close. I'm not even convinced Palantir ever is going to get to a revenue number that Salesforce has. So the fact that the company's valued larger than Salesforce shows, one, Palantir's significantly overvalued. Doesn't mean it can't get more overvalued, right? And two, it shows like Salesforce is incredibly undervalued right now. So just something to keep in mind there. And all that will be proven out. I know Palantir inside and out. I know Salesforce inside and out. Trust me. Palantir's valuation likely peaks in 25 and then starts to go down and goes through a really tough time. That's why I've sold the far majority of my shares. And when I say a tough time, it's going to go through a tough time for years. And Salesforce is just going to continue to get larger and larger. And we'll see Salesforce eventually likely get to a $500 billion market cap. In long term, they have the potential to become a $1 trillion company. When I say long term, if we're talking like 10 years out, they could get to a $1 trillion market cap over time. Okay. So Palantir, I'm not sure they'll ever get to a $1 trillion market cap, just to be quite frank. Alrighty, number 7 of these 7 stocks up here is AMD, Advanced Micro Devices. This is a stock that I've been buying very heavily. I would say probably, when did I start buying this one? I think it was the end, maybe it was the beginning of this year, the end of last year. And just kept acquiring shares. Now we're up over $101,000 in the stock. Cost base on this one, $111.61, 2,555 shares in the public count. What an incredible opportunity of an investment this is, okay? No. This is my bold case for AMD. 30% revenue growth per year. Based upon the 350 chips that are really going to be meaningful for 27 and the 400 series, which is going to really, really matter for 27, 28. I think 30% is actually pretty doable under a bull case scenario, right? 40% net income growth, if they're doing 30% top line, 40% bottom line, even for a semiconductor company, which usually don't get the biggest, PEs, I think a 40 to 60 P's fair for a bull case like this. It gives you a compound annual growth rate on the low end, 37%, and on the high end, 51%. But what do I actually expect? My base case is always what I actually expect with slightly conservative view. So my base case for AMD has them growing 25% on average per year. Now keep in mind, I think the revenue growth in 26 will be way above 25%. 27 is going to be way above 25%. So just keep that in mind. And then maybe a slowdown in 28, 29 when it comes to revenue growth. But the average will be 25% in my opinion. 35% net income growth on average per year is very doable for AMD over the next number of years. 35 to 40 P would be pretty fair for a company growing at these sorts of growth rates. 27% compound. Remember, this is my base case. In my base case, 27% compound annual growth rate on the low end, 32% on the high end. I've got to take that. So if you wonder, wow, I'm already up $100,000 plus on AMD. Why am I not taking any profits? Because the stock's likely headed to 400 plus. So I'm in no rush to take any profits on AMD. Under my bear case, this would be a disaster for AMD. 15% revenue growth, 20% net income growth on average. This would be embarrassing. Lisa Su would forever be embarrassed for this. 20 to 25 PE, basically that gives me a negative 1% return over time to maybe 4% compound annual growth rate, right? That would be really, really bad. No, Lisa Su, here's the deal. She's had her back up against the wall many times. She's led this company since it was like a $2 Chuck stock. And shortly after she took it over, I remember the stock was like $1.91, $1.70 something. And she's made it into one of the most important companies in the entire world now at this point in time. And so, clap it up for her. And I feel very comfortable with somebody like Lisa Su leading the company. And she seems like she's head down, as focused as she's ever been. And so, people like Benioff, people like Lisa Su, man, these are legends in the business space. And I'm more than happy to have them leading the companies I invest into. Okay. I appreciate everybody joining me as always. Thanks so much for being here. This was a beast of a video, 47-minute video. Oh my gosh. I hope you guys appreciate this one here today. If you're looking to apply to our private stock group, you want my entire library of premium courses. You want access to my private Discord chat, exclusive weekly videos, see what stocks I'm buying and selling each week, pin comment down there, click on that, fill out a form, see if we can get you access, and then let's get you up to a much higher level than where you're at right now. Much love and have a great day.